Hello students, today we are going to start with heads of income. The very first head of income that we are going to study is income from house property. Okay, income from house property is given under chapter number 4 in module number 2 under unit number 2 of chapter number 4. Income from house property is there. Income from house property is given on page number 4.120. I hope this is quite clear to you all. So let's come back to our notes. Okay. Under this chapter, income from house property, we need to understand what does house property means primarily and how income from house property will be chargeable to tax. Okay, so in order to understand the chargeability of income under the head income from house property, we need to study section 22. Section 22 talks about the chargeability of income from house property. The process of computing of income from house property starts from ascertaining the annual value of the house property. So this word, the annual value of house property, is a technical word that we will understand after reading this entire section, that is section number 22. Okay. There are conditions given for the purpose of charging income under the head income from house property. So what are the conditions that have been given? Let's understand that. The first condition is property must consist of any building or land apparent to thereto. Basically, this condition helps us to ascertain whether a particular property will be considered as house property or not. Okay. Then the second condition says that assessee must be the owner of such house property or such property. Okay. Then third condition says that house property must be used for any purpose except means other than for the purpose of business, that is PGPP. I hope this is quite clear. So under the head of exception, we will study that annual value of the following, that means this, shall be charged under the head income from PGPP. That means if an assessee is following this, okay, then whatever income the assessee is earning will be chargeable under the head income from PGPP and not under the head income from house property. I hope this is quite clear to you all. So let's read what all exceptions are given. First exception says that the portion of the house property occupied by the assessee for the purpose of carrying out any business or profession by himself, that means the assessee himself is carrying on a business and profession in that house property, then whatever income he has earned from such portion of the house property will be chargeable to the head income from PGPP and not under the head income from house property. I hope this is quite clear. The second exception says that assessee has engaged the house property in letting out business of property. That means assessee is having a house property and he has taken that house property in the letting out business of house property, then whatever income that assessee is earning from letting out business of the property will be considered as income under the head income from PGPP, but it will not be considered under the head income from house property. I hope this is quite clear to you all. Okay, so now let's understand section 22 in detail. So let's start with what property will be considered as house property. Okay, so basically it is given in this first condition that property must consist of any building or land apparent to thereto, then only it will be considered as house property. So let's come back into our study material. Okay, here they have explained us what does a building means and what does land apparent to thereto means. Basically a building includes not only a residential building, but it also includes a factory building, a office premises, a shop, a godown and any other commercial premises. Okay, and land apparent to thereto means land connected with a building like a garage, etc. Okay, so let me explain it to you over here that if a assessee is having a property and such property is any building, a building can be a flat, okay, a office building, a godown, okay, a factory premises or a shop. So then also such building or such property will be considered as house property. Or land apparent to thereto means any property connected to a land. This is a land and a property is connected to a land. Then the entire this property as well as the land will be considered as house property. That is what this land apparent to thereto means. I hope by now you all are able to identify which property will be considered as a house property now. So if an building is there, a building will be considered as a house property if such building is a flat, if that building is a standalone house, if that building is a godown, if that building is a shop, if that building is a residential premises or not a residential premises but a commercial premises, then also it will be considered as house property. But there is a condition that such house property must be used for any purpose other than, that means except then, for the purpose of business. If such house property are used for the purpose of the business, that is PGPP, then this exception will be applicable and the annual value of the following shall be charged under the head income from PGPP. I hope this is quite clear by now. So I hope you all are able to identify whether a property will be house property or not. So primarily, in order to charge the income from a house property, we need to identify whether such property is a house property or not. And second condition is very self-explanatory, that assessee must be owner of such property. Why is this so? I'll explain it to you whenever we are moving further. Okay. So now we have understood what does a property means. The very next thing that we need to understand is there are different types of property. So come on the next page of the notes. The house property is further categorized into two parts, that is, a house property can be given on a rent and a house property can be not given on a rent. I hope this is quite clear. If a house property is given on a rent, such house property is known as a let out house property. But if a house property is not given on rent, it is categorized into two parts, that is, if an assessee is having two house property or up to two house property, then such properties will be considered as self-occupied property. Self-occupied property means such properties are being utilized by the assessee for his own residential purpose or for his own use. I hope this is quite clear. But if the assessee is having more than two house property, okay, for example, if the assessee is having five house property, then it is categorized into two parts further. Any two house property with highest annual value will be considered as SOP. What does SOP means? SOP means self-occupied property. And what does annual value means? Don't worry, I'll explain you after understanding this part. Okay. So basically, let's understand it again. If an assessee is having a house property and such house property is not rented, but assessee is having more than two house properties, so we have taken, for example, the assessee is having five house property. So out of this five house property, we have to select two house property with the highest annual value, and that will be considered as self-occupied property. And then the remaining house property, that means the three house property with lesser annual value, will be considered as DLOP. What does DLOP means? DLOP means deemed let out property. Okay. So what does this deemed let out property means? Don't worry, I'll explain it to you all. Okay. So let's come into a blank page. There I'll explain you three categories, that is LOP, SOP and DLOP. Okay. Let's come here. The house property is categorized into two parts, that is rented property and not rented property, and further categorized into LOP, SOP and DLOP. So let's understand what does LOP means. LOP simply means house property is given on rent, okay, and assessee may earn income from such house property, or he may incur loss from house property. I hope this is quite clear. Then in SOP, SOP means house property is utilized by the assessee for his own use. I hope this is quite clear. There is a possibility over here, the assessee, if he is having a self-occupied property, then a self-occupied property will incur a loss, okay, will incur a loss. I hope this is quite clear. So you all might be thinking that if a house property is let out, then there is a possibility that an assessee will earn an income, okay, and there is a possibility that let out property may incur a loss. But how come a self-occupied property, that means even if the property is not given on a rent, how that house property will incur a loss? So that is what we are going to study in our chapter, that is income from house property. Over here I have made a table over here to make you all understand how that assessee will incur a loss. So if you can see over here, there I have written self-occupied property, and finally here I have made a minus sign. So finally, if here assessee is not earning any income but he is earning a loss over here, and finally this loss will be taken into our total income and can be set off against the heads of income. I hope this is quite clear to you all. So that's why we have studied set off and carry forward earlier, so that we can utilize that concepts over here in our head of income chapters. I hope this is quite clear to you. So coming back to our blank page, okay, so this three category is there. I hope you all have understood this. LOP, DLOP and SOP. Okay. So we have understood what does LOP means. LOP simply means the property is given on a rent. SOP simply means the assessee is utilizing the property, but you are not aware what does DLOP means. DLOP stands for deemed let out property. So firstly, I hope you all have understood what does let out property means. Let out property means the assessee has given such property on rent. So we need to understand this word, what does deem means. So basically deem means the income tax is considering that even if you have not given a particular house property on rent, such house property will be considered as earning a notional income, and such notional income will be chargeable to tax. I hope this is quite clear. So we have studied there are three types of house property: let out house property, self-occupied house property, or deemed let out house property. So now is the time when we need to understand what does this word annual value of house property means, so that I can explain you in detail how DLOP came into picture. Okay, so let's understand what does annual value of house property means. Annual means yearly. Okay, and value means over here rent income. Okay, so now let's read it completely. Annual value of house property means yearly rent income of house property. I hope this is quite clear to you all. So now again let's read section 22. The process of computation of income from house property starts from ascertaining the annual value of the house property. Ascertaining means calculating. Okay, so in order to ascertain annual value of house property, here a entire table is given by the income tax. Okay, under chapter income from house property. So we need to study that. Don't worry, it is a very simple format and you will enjoy the format. Once you understand all this, then you will definitely score full marks under this chapter. Okay, if any question is asked in exam, let's revise it. Okay, so section 22 says that the process of computing of income from house property starts from ascertaining the annual value of the house property. So this is also a technical word. Ascertaining means calculating. We are calculating what? Annual value of house property. Annual value of house property in layman terms means yearly rental income from house property. I hope this is quite clear. So let's come back to our blank page and take a new page over here and let's understand it over here. So there is a complete format. Okay, let's come back to our notes. Here I am showing you a particular format. Okay, this format has been given by Income Tax Act under this chapter income from house property. Why this format was introduced? For that I am creating a base over here. Okay, so understand it now. So if you understand the base, automatically you will be able to remember this format, why this format came into picture. Okay, so understand over here there is this assessee named Shyam. Okay, he is having a house property. Okay, he has given his house property on rent for 12 months at the rate 3 lakh per annum. Okay, so basically here we can understand that Mr. Sham here is earning rupees 3 lakhs. Okay, from renting of house property. So basically this 3 lakhs what he has earned will be chargeable under income from house property head. Okay, and it will be taken into total income of the assessee in order to find out final tax liability. I hope this is quite clear. So in layman terms I have explained you how the flow will work. Mr. Sham is there. Okay, he has a house property. He has given his house property on rent for 12 months at the rate 3 lakhs per annum. Mr. Sham here is earning rupees 3 lakh from rent of house property. So basically this 3 lakh will be chargeable under the head income from house property, and the income whatever he has earned under the head income from house property will be taken into the total income of the assessee, and then we will find out the final tax liability on this income. I hope this is very much clear. So now here our annual value concepts come into the picture. Okay, so here our annual value concept comes into picture. Okay, so what does annual value mean? So in order to ascertain annual value, we have been given a format. So this format we will study in our notes. Okay, so the format says that if the municipal value is given and the fair rent is given, whichever will be higher, we'll consider it over here, and whichever is higher and the standard rent is available, whichever is lower of this two will be considered as expected rent, and from the expected rent that has been derived, the actual rent will be compared, and out of this two, whichever will be higher will be considered as gross annual value. Okay, let's understand over here. So basically what does municipal value means? Okay, we need to understand it. Municipal value means value of rent decided by municipal authority. MA means municipal authority. Okay, second is fair rent. What does fair rent means? Fair rent means municipal value. MV means municipal value is decided, okay, decided by municipal authority, but the fair rent of such house property is much higher. Okay, is much higher or much lower. Okay, so that's why fair rent concept came into picture. Don't worry, I'll explain it to you again. I am just creating a base right now. Okay, so be little patient. And what does standard rent means? Okay, standard rent means standard rent is decided. You don't need to write any of this thing. Okay, you just need to understand, because in exam they will not ask what does municipal value means, what does fair rent means, what does standard rent means. I am just creating a base so that you all understand this format easily, because in exam you need to only write this format. You don't need to learn all these things. This is for your understanding. Okay, standard rent is decided as per the house property in a particular area. Okay, so that the rent of the house property in that area remains same. Okay, so what is all this? Let me explain it to you. So I'll explain you with the help of an example. So earlier in our example we had Mr. Sham. So let's take that SSE only, Mr. Sham. Mr. Sham is having house property in a posh area in Mumbai. Okay, and he is giving his property on rent to a tenant at the rate 10 lakhs per annum. Okay, but the municipal value, this MV decided by the municipal authority, is rupees 12 lakhs per annum, and the fair rent decided is rupees 11 lakhs per annum, and the standard rent of that area is rupees 14 lakhs per annum. Okay, so if you can see over here, this assessee is charging the rent from the tenant of rupees 10 lakhs per annum. I hope this is quite clear. But the municipal value decided by the local authorities or the municipal authorities is 12 lakh per annum, and the fair rent is 11 lakhs per annum, as well as standard rent is 14 lakhs per annum. Okay, so the annual value of the house property, that means the annual value which will be calculated for the Sham, that is our SSE, will be in this manner. Okay, why we are calculating all this? We are calculating in order to find out the gross annual value. Gross annual value means yearly rental income of the assessee. Okay, so Here in the place of municipal value, so I am writing under the tab of let out property only. So let's erase this over here for time being, and let's understand how things will work. Okay, so the municipal value given in the question is 12 lakhs. We will simply feed that detail over here of 12 lakhs. Okay, and the fair rent given in the question is say 11 lakhs. Okay, so whichever is higher of this two, 12 lakhs. Okay, and the standard rent in that area is 14 lakhs. Okay, so whichever is lower of this two will be considered as expected rent. Okay, so we will write expected rent to be 12 lakhs. Okay, and the actual rent that we have received is 10 lakhs. So the GAV, that means the gross annual value, will be higher of this two, that is the expected rent and the actual rent. So that means the gross annual value will come around 12 lakhs. So basically, I hope I have created a base that how we will calculate a gross annual value even if the assessee is charging a rent of 10 lakhs per annum, but as per income tax the rent income of the property should be 12 lakhs. So that's why the gross annual value of the property will be 12 lakhs irrespective he has only earned 10 lakhs of the income. I hope this is quite clear to you all. Okay, now let's move back to our blank page. Okay, so I'll explain you why income tax was doing this injustice on the assessee. Even if he had earned an income of rupees 10 lakhs, why the gross annual value is calculated to 12 lakhs. Okay, so I'll explain it to you all why this particular process was brought into picture. So understand here, Shyam is there. Okay, his actual rent is 10 lakhs. Okay, but the expected rent is 12 lakhs per annum. Okay, I hope this is quite clear to you all. So basically, why this particular expected rent concept came into picture, because earlier in the earlier days what this assessees used to do, they used to have this house property. So what they used to do, they used to rent their house property. Okay, and they used to ask the tenant to pay the rent in the following manner. So for example, if the rent of the house property is say rupees 10 lakhs, they would ask the tenant to pay them 5 lakhs per annum by check or in the bank or by any mode other than cash. Okay, and they would ask the remaining balance 5 lakh to be paid in cash. Okay, so basically what they were trying to do with this adjustment was they used to show only 5 lakh as their actual rent, and this 5 lakh, on this 5 lakh they used to not pay any tax. They were trying to evade tax with this adjustment. So what income tax did, they made this concept, okay, municipal value fair rent whichever is higher, okay, and whichever is higher versus standard rent whichever is lower will be considered as expected rent, and whatever expected rent is derived will be compared with the actual rent. Then the expected rent and the actual rent whichever will be higher will be considered as the gross annual value of the house property. That means whatever gross annual value have been derived, on that gross annual value a municipal taxes will be reduced, and on the net annual value or deduction under section 24 will be allowed, and finally income from house property will be derived, and this will be taken into our total income, and on this income a final tax will be calculated. I hope this is quite clear. So I hope you all have understood why this particular table came into picture and why this expected rent concept came into picture, because the assessees were trying to evade the tax. Many of the time what they used to do, they used to not show even this 5 lakh, they used to take entire money in a form of cash. So that's why DLOP concept came into picture. So now is the time where I'll introduce what does DLOP means and how does DLOP came into picture. Okay, so let's understand this. So let's take a different assessee. Let's take Radha. Okay, so Radha has 3 house properties. Okay, so what she's saying I am utilizing all these 3 house property as self-occupied house property, but out of this 3 house properties she is letting out house property 2 and 3. Okay, and in house property 1 she is staying. Okay, but she is not receiving the rent income in the bank, she is receiving the rent income in a form of cash. So in order to avoid all this adjustment done by Radha, income tax department has came up with this concept what we have studied over here in the notes, this non-rented part. If assessee is having more than 2 house property, any 2 house property will be considered as SOP and remaining house property will be considered as DLOP. But still we need to understand what does DLOP means. So that's why I'm creating a base, and after 5 to 10 minutes you come to know what does DLOP means. Okay, so if the assessee is having this 3 house properties, so we'll write this house properties detail, house property 1, okay, then house property 2, then we'll write house property 3. And from house property 1, she is not earning any rental income because it is a self-occupied house property. Out of this house property 2, she has let out such house property, that means it is a LOP. And house property 3 also she has let out, but she is not showing in the books, she is taking the rent money in the form of cash. Okay, so what income tax said is, in assessment year 2020-21, that if an assessee is having 3 house property and if she is claiming that, or if he or she is claiming that all the 3 house property are self-occupied house property, then out of this 3 house property we have to consider any 2 house property as self-occupied house property, and 1 house property we need to consider as deemed let out house property. So now here we need to understand what does deemed let out property means. So basically deemed let out property means that, see, if you are having 3 house property, even if we consider that 1 house property is for your own use and 1 is for your parents use or for family use, then at least 1 property, that means the last third property, you should rent it. Okay, if you are not renting it, that means income tax is thinking that there is something wrong what you are doing, because there is a possibility that you may be renting this house property but you are not showing in your books and you are trying to evade the taxes. So in order to avoid that, they came up with this DLOP. DLOP says that if 2 house properties are SOP, then the remaining house property will be considered as let out house property. But since we are not actually letting out, that means our actual rent will be 0. She is saying it is a self-occupied only. Okay, that means she has not rented such house property. Then how will the income tax calculate the annual value of such house property 3? So basically what will be done is, in Miss Radha's case, is the house property 1 as well as house property 2 as well as house property 3's annual value, okay, annual value will be calculated. How the annual value will be calculated? Annual value will be calculated in this manner. But you will say, sir, that actual rent is not there. How will the income tax department calculate the annual value? So let's understand how we will calculate annual value for the house properties if the house properties are not actually let out. So this formula will come into picture, where the income tax officer, that is income tax ITO, which stands for income tax officer, will ascertain the municipal value for the house property, and then he will also ascertain the fair rent of the house property. Whichever will be higher will be considered over here, and whichever will be higher will be compared with the standard rate as found out by the income tax officer, and it will be compared. Whichever will be lower will be considered as expected rent. Okay, and expected rent and actual rent will be compared together. Even if the actual rent is 0 and expected rent is say rupees 10 lakhs, the gross annual value will come to 10 lakhs. I hope this is quite clear, because expected rent of rupees 10 lakhs is higher than the actual rent 0. So that means 10 lakh will become the gross annual value. So basically DLOP concept came into picture because many of the times assessors are having more than 2 house property, but they are not willing to rent that house property. So they were arguing that since we are not renting such house property, why we will pay taxes on that? But income tax department is saying that no, if you are having more than 2 house property, we understand that for first and second house property you are using it for yourself, but why you need the third house property? You either rent it and incur an income, okay, and pay the taxes. But if you are not willing to rent that house property, then you have to pay the taxes as per the format, even if you have not actually received any rent. I hope this is quite clear. So the explanation was quite tricky, but when we will solve the sum, that time things will become real easy. Okay, so I just want to explain you one more thing that we have studied. Okay, so basically we have studied this municipal value, fair rent, standard rent. Let me tell you all, this all things comes into picture only during the time of assessment. Okay, what does assessment mean? Okay, assessment means checking. So basically, let's understand in layman terms. You write the solution in your answer sheet, and the examiner assesses your answer sheet. Okay, so basically, assessee files his income tax return, and income tax officer assesses his ITR, that is income tax return, and checks whether he has calculated his income in a proper manner as per the Income Tax Act or not. I hope this is quite clear. So that time only this parts will come into picture, that is the municipal value, fair rent, standard rent, expected rent. Because when the assessee is himself calculating his gross annual value, he will only consider actual rent. Because as far as I remember, when I was calculating my income, okay, that time income from house property, my actual rent was whatever the rent I was actually receiving. Okay, I never considered this municipal value, fair rent, standard rent, expected rent. If the assessing officer checks my income tax return, and if he's satisfied that actual rent is enough, sufficiently enough, okay, then he will not come for the scrutiny. So if the assessing officer is checking my income tax return and he feels that okay, the actual rent has been calculated by the assessee at this amount, and if he does not feel any suspicion, he will not come and scrutinize my income tax return. But if the assessing officer feels that the assessee has tried to evade the taxes by reducing his income, that is the income of the house property, then he will scrutinize. That means he will open an assessment against that assessee, and that time he will ascertain the municipal value, fair rent, standard rent, expected rent, in order to calculate the annual value, that means the gross annual value. Because assessing officer thinks that the actual rent disclosed by the assessee is way lower than the expected rent. Okay, so basically this all we need to solve in our exam. But in real life, while computing the income of an assessee, for example, after 3 years you will become a chartered accountant, and a particular assessee comes and he has an income from house property. That time you don't need to see the municipal value, you don't need to see fair rent, you don't need to see the standard rent. This all things will be seen by the income tax officer. Okay, if he feels that the actual rent is below the expected rent. I hope this is quite clear. So I tried to connect this concept with the real life scenario also. So by now we have understood SOP, LOP and DLOP. So let's revise it in a speedy manner so that even if you have some doubt, it will get automatically clear. Okay. So let's start with section 22 again. Section 22 says that chargeability of income from house property. The process of computing of income from house property starts from ascertaining the annual value. I hope now this sentence you understand completely. So what does this sentence is? The computation of income from house property starts from calculating. Ascertaining means calculating the yearly rent income of the house property. So by now you know how to calculate the yearly income, that is the gross annual value or the annual value of the house property. Okay, so this is just a process that the institute wants us to follow, but in real life you will only follow from here actual rent and gross annual value, then you will reduce municipal taxes and you will find out net annual value, then you will reduce deduction under section 24, and then you will finally find out income from house property. But this all up to expected rent will come into picture if the assessing officer, that is income tax officer, opens your income tax return for assessment. Okay, condition for the purpose of charging income under the head of income from house property says that the first condition is property must consist of any building or land apparent to thereto. So from our study material we came to know what does building means. Building includes not only residential building but also factory building, office, shops, godowns and other commercial premises. And land apparent to means land connected with the building. I hope this is quite clear to us. And second point says that assessee must be the owner of such house property. And third point says that house property must be used for any purpose except then for the purpose of PGPP. So that's what our exception is about. Exception says that annual value of the following shall be charged under the head income from PGPP. First point says that portion of the house property occupied by the assessee for the purpose of carrying out any business or profession by himself will be charged under the head income from PGPP, that is business and profession. The second point says that assessee has engaged the house property in letting out business of property, then whatever income the assessee has earned from such letting out business of the property will be charged under the head income from PGPP, that is business and profession. I hope this is clear. So we have studied the format. This format helps us to ascertain the annual value and finally helps us to calculate income from house property, which will form part of our total income and finally taxable. Okay, I hope this is quite clear. In order to calculate the gross annual value, the question will provide us with the fair value as well as the municipal value. Whichever will be higher, we have to find it here, and then we have to compare whichever is higher with the standard rent, and out of this two, whichever will be lower will become our expected rent. So that's why over here I have written whichever is lower for this. Okay, I hope this is quite clear. Then the expected rent and the actual rent will be compared. Whichever will be higher of this two will be considered as gross annual value. Okay, and from this gross annual value, municipal taxes will be reduced and we will find out our net annual value. Then we will reduce deduction under section 24. So what is that deduction under section 24? We will understand it. So we have understood this column. We need to understand let out property column, deemed let out property column, and self occupied property column. Okay, so I hope by now you all have understood a lot of things. Okay, you all have understood this properties bifurcation also, rented as well as non-rented. So basically, if an assessee has rented his property, even if he is having two house property or even if he is having one house property also, such rented house property will be considered as let out property, and on such let out property he has to pay tax. But if the assessee has not rented his house property, then if he is having only two house property, that all the two house properties will be considered as self-occupied house property. But if he is having more than two house property, then any two house property with the highest annual value will be considered as SOP, that means self-occupied property, and the remaining house property will be considered as DLOP, that is deemed let out property. So what is deemed let out property? I hope you all have understood. Deemed let out property is simply mean that the notional income, okay, of the house property will be calculated by the income tax department, okay, and will be chargeable to tax. So basically you all might be asking this question that, as I told you earlier, this all up to expected rent is done by income tax officer. Okay, then how will this deemed let out property, a particular assessee will do his assessment while calculating his total income? So simply what he has to do is he should be aware of the actual rent, okay, what he would have charged on the deemed let out property, and he should consider that actual rent over here. Okay, and if he is aware of the actual rent that he would have charged if he would have not simply kept that house property as it is, then that is sufficiently enough. You don't need to calculate all this. Okay, so I hope this is quite clear by now. So let's understand each of these columns, okay, individually. So if an assessee is having a let out property, then he may definitely earn an income or he may definitely earn a loss. Similarly, earlier I told you that a self-occupied property owner may not earn any income, okay, but that owner may incur a loss. So how that loss can be incurred, I'll tell you over here. And in the deemed let out property column, a particular assessee may not earn a actual rent, but he has to calculate the gross annual value, okay, for self-assessment purpose, and here also he may earn income or he may earn a loss. I hope this is quite clear to you. So let's come back to our blank page and let's understand over here. So now let's understand in a proper manner. Okay, if an assessee is having four house property, okay, if an assessee is having a four house property and three house property are self-occupied house property and one house property is let out house property, okay, so the bifurcation says that four house property, three house property is equal to SOP, that means we'll write over here NR, that means not rented, and one house property will write here R. This does not means resident and this does not means non-resident. This means not rented, okay, and this means rented. Okay, do not get confused if you are copying the thing whatever I am writing on the screen. Okay, so please be very conscious while you are listening to my lectures. Do not simply copy the stuff. If you understand the stuff, it will automatically remember in your brain for a longer period of time, because the notes that you are seeing on your screens right now are sufficiently enough to remember all the concept that I am teaching you. Okay, so just don't worry about it. So basically our example starts like this. If an assessee is having four house property and out of this four house property, three house property are self-occupied house property as claimed by the assessee, and one house property is let out house property. So out of this four house property, this one is rented and these three are not rented. So for this we have already studied that out of this three, we need to find out two house property that will become a self-occupied house property and one house property will become DLOP. I hope this is quite clear. House property 1, house property 2, house property 3, house property 4. Okay, the municipal value for house property 1 is rupees 10 lakhs. For house property 2 is 11 lakhs. House property 3 is 12 lakhs. And house property 4 is 13 lakhs. Okay. Fair rent is 11 lakhs, 12 lakhs, 13 lakhs, 14 lakhs. Okay. Standard rent is 9 lakhs, 10 lakhs, 11 lakhs, 12 lakhs. Okay, and the actual rent charged for this house property 1, house property 2, house property 3, house property 4 will be as follow. So basically what our example was, the example was if an assessee is having 4 house property, out of this 4 house property, 3 house property are self-occupied house property and only 1 house property is let out house property. So that means our house property number 4 we will consider as actually let out. So the actual rent will be available only for house property number 4, and for this house property 1, 2 and 3 no actual rent will be available. Okay, so out of this 3 we have to consider the highest 2 house property with highest annual value. Okay, so how that works I'll explain you with this example. So basically the actual rent for house property 4 is say rupees 14 lakhs only. Okay, and the actual rent for house property 1, 2 and 3 are not available. So how we will ascertain out of this 3 house property which 2 house property has to be considered as SOP? So that is what we are going to study. So for time being we will not consider this house property 4 because any which ways we will calculate annual value for that. Okay, so we'll consider this 3 only. Okay, so if house property we need to finally find out GAV. Okay, whichever GAV will be highest, the 2 highest GAV will be considered as self-occupied house property. I hope this is quite clear. So municipal value plus fair rent whichever will be higher is 11 lakhs and whichever will be higher and standard rent whichever will be lower will become expected rent. So our expected rent, okay, I'll write over here, expected rent is equal to 9 lakhs. Okay, and actual rent is equal to 0. So whichever is higher of this two will become GAV, that is gross annual value. So that means our gross annual value comes to around 9 lakhs. Okay, and less municipal taxes which is 0. So that means net annual value comes to 9 lakhs only. I hope this is quite clear to all. So in house property 2 the expected rent will be how much? Let's see. Municipal value plus fair rent whichever is higher is 12 lakhs. Okay, 12 lakhs will be compared with the standard rent whichever will be lower will be as expected rent. So that means expected rent is 10 lakhs. Okay, so we'll write over here 10 lakhs. Okay, and actual rent is 0. Whichever is higher of this two, that means 10 lakhs and 0 will be considered as GAV, that is 10 lakhs, and municipal taxes are also 0 for house property 2. We are assuming that. Okay, so that means the NAV is equal to 10 lakhs. I hope this is quite clear. Similarly for house property 3, the expected rent will become municipal value compared to fair rent whichever is higher is equal to 13 lakhs and 13 lakhs will be compared with the standard rent, that means 11 lakhs. 13 lakhs and 11 lakhs whichever is lower is 11 lakhs will be considered as expected rent. Okay, I hope you all are keeping this format in front of you. Okay, so then only you will understand what I am doing over here. So if you have not kept this format in front of you while I was solving this part, just rewind the video and listen it to whatever I am saying again. So actual rent here is 0. That means our GAV will come to 11 lakhs. Okay, and our municipal taxes are 0. That means our NAV will finally become 11 lakhs. Out of this 3 property, whichever 2 property are having highest NAV will be considered as our self-occupied house property. So you can clearly see that 11 lakhs and 10 lakhs are higher than 9 lakhs. So that means this house property 2 and house property 3 will become SOP and house property 1 will become DLOP. And this finally house properties 4 NAV we also will calculate. So let's calculate the NAV of our house property 4. So we will compare municipal value plus fair rent whichever is higher, that means 14 lakhs is higher, and 14 lakhs will be compared with whom standard rent, and whichever is lower of this 14 lakhs and 12 lakhs will be become our expected rent. That means our expected rent is equal to 12 lakhs, okay, and 12 lakhs will be compared with the 14 lakhs, that is actual rent, whichever is higher will become our GAV. That means our GAV is equal to 14 lakhs and municipal taxes are 0. That means our NAV is equal to 14 lakhs. I hope this is quite clear. This is let out house property. So I hope by now at least you are aware how to find out which property can become SOP and which property can become DLOP. So primary what I wanted to explain you was this part. Any two house property with highest annual value will be considered as SOP. I hope this is quite clear to you all by now. Okay, so let's revise the entire thing what we have studied. So as we have studied section 22 says that the process of computing income from house property starts from ascertaining, that means calculating the annual value of the house property. So there are conditions for the purpose of charging income under the head income from house property. In order to consider a particular income to be taken under the head income from house property, firstly such property must be a house property. In order to identify whether a property is a house property or not, that is what is given in the first condition. The second condition says that in order to take a income under the head income from house property, the assessee must be the owner of such house property. Then only the income earned from such house property will be taken under the head income from house property. And third point says that house property must be used only for purpose other than the purpose of business. Okay, so that is what our exception is about. Exception says that first point, portion of the house property occupied by the assessee for the purpose of carrying out any business or profession by himself will be chargeable under the head income from house property. And if the assessee has engaged the house property in letting out business of the property, then whatever income that assessee is earning from the letting out business of the property will be chargeable under the head income from BGPP, that is business and profession, and not under the head income from house property. I hope this is quite clear. And we have studied our format. Our format says that if an assessee has let out his house property, but if the assessee has not let out his house property and assessee is having more than two house property, then there is a bifurcation of self-occupied house property and deemed let out property. So if an assessee has let out his house property, we need to calculate the expected rent with the help of this format, which says that municipal value compared to fair rent, whichever is higher we need to mention it over here, and we need to compare it with the standard rent, and whichever is lower out of this two will be considered as the expected rent, and the expected rent will be compared with the actual rent. Whichever will be higher will become a gross annual value, and gross annual value will be further subtracted by the municipal taxes, and we will find out our net annual value. I hope this is quite clear. In case of DLOP, we need to calculate the expected rent because the actual rent will not be available. We are notionally considering this income, okay, in the total income of the assessee. But in case of self-occupied property, assessee will not have any net annual value because he has been using such house property for his own use. Okay, I hope this is quite clear to you all. So while revising this format, we have studied about this municipal taxes. So what is this municipal taxes? We have simply studied that municipal taxes will be subtracted from the gross annual value. So what is this municipal taxes? So what does municipal taxes means? Come on page number 3. Municipal taxes means it is allowed on paid basis. It is also known as local tax, water tax, property tax, house tax, cess on municipal tax, scavenging tax, sewage tax. So basically if an assessee is paying this kind of taxes, so this kind of taxes are allowed as deduction from this income. So basically income less expenses. Okay, so this municipal taxes is kind of an expenses which is allowed as deduction from the income. I hope this is quite clear, but there is a condition. It is allowed on paid basis. Allowed on paid basis simply means actually paid by the assessee in the previous year 2019-20. But if the municipal taxes are paid by the tenant, then the municipal taxes will not be reduced from this gross total income. I hope this is quite clear to you all. So that is what our last point is saying. It is allowed as deduction only if borne by the assessee. Borne by the assessee simply means that, I'll write it over here, earned rent income. So pay taxes from that only. Okay, if an assessee is earning an rent income and he is paying taxes from that rent income, then only this municipal taxes will be allowed as deduction from gross annual value. I hope this is quite clear to you. Okay, if the tenant is paying over and above the rent that he is paying to the assessee, then such municipal taxes paid by the tenant will not be reduced from the gross annual value. So let's understand it over here. Okay, for example, if Mr. A is receiving rupees 1 lakh per annum, okay, and this rupees 1 lakh is GAV, okay, and Mr. A is not paying municipal taxes, okay, tenant is paying municipal and the tenant is paying municipal taxes of rupees 10,000 per annum, okay, then this GAV will not be reduced by municipal taxes, okay, so that means 1 lakh minus municipal taxes, that will become 0, and finally our NAV will become 1 lakh, okay. But if this 10,000, okay, if this 10,000 would have not been paid by the tenant but paid by the assessee, okay, then only it would be allowed. That means this 10,000 then only will be allowed, okay. So that means finally the NAV will become 90,000. I hope this is quite clear to you all. Okay, so there are different kinds of adjustment. If you understand this part only, that is sufficiently enough, you will automatically understand all the different kinds of adjustment, like permutations and combinations made by the question. Okay, so you just simply need to understand that if an assessee who has given his property on rent, and if he is receiving the rent, and if he is not bearing that municipal taxes from his own pocket, then this municipal taxes will not be allowed as deduction from the GAV. I hope this is quite clear. And if the assessee is receiving the rent and he has asked the tenant to pay the municipal taxes over and above this rent income, then this municipal taxes will not be allowed, okay. But if the assessee has received this rent income and he has bared this 10,000 municipal taxes from his own pocket, okay, then the 10,000 will be allowed as deduction. So I hope municipal taxes is pretty much clear by now, okay. So up till here we have finally completed everything, that is net annual value. So on this net annual value there is a further deduction available under section 24. So what is this? Okay, we'll understand that deduction under section 24 subsection A, standard deduction at the rate 30% of the NAV, and deduction under section 24 subsection B, interest on loan, is allowed as deduction from this net annual value. Okay, so I want you all to understand few things, that is, if an assessee is giving house property on rent, okay, he is earning this rent as income, okay, so he might also incur some expenses, okay, so whether these expenses can be allowed as deduction from this income, so the answer is no. So for that purpose, Income Tax Act under income from house property head has given a standard deduction, okay, a standard deduction of 30% of the NAV, thinking that assessee might have incurred certain expenses, okay. So that is what this first subsection is. Deduction under section 24 subsection A says that standard deduction at the rate 30% of NAV, and further one more deduction will be allowed, that is interest on loan, okay. So what interest on loan this deduction under section 24 subsection B is talking about, that we will understand by coming on the next page. That is, here I have written section 24, allowability of interest irrespective of the borrowed from any sources. So as our heading suggests, earlier in section 80C, okay, in point R we studied that if an assessee has taken a house property, okay, that means he has purchased a house property and such house property is taken on a loan, then the principal repayment of the loan amount will be allowed as deduction under section 80C, and there we have studied that the interest component will be available in the income from house property chapter as deduction under section 24. So that is what we are going to study over here, okay. So let's understand the prima facie important things like allowability of interest irrespective of borrowed from any sources. In under section 24 we need to see from where the assessee has borrowed the loan, okay, because in our section 80C in our part there were specifically if the loan has been taken from the employer, then who should be the employer? If not taken from the employer, then from which sources he should be have taken the loan? The sources were bank, okay, LIC or other housing banks, okay, that we have studied under section 80C, okay, under point R. I hope you all remember that. So in this section 24, is there any such condition? So by reading this part, you all might be aware that by now that if an assessee has taken a loan and if he is paying interest on such loan, the borrowed capital can be from any sources. It has to not be from a specific source like a particular employer or a particular bank. Okay, so let's read this entire thing and then I'll further explain you, because there is one more chart that we need to study. Okay, this is specifically for interest on loan only. Okay, so let's read first section 24. In section 24, first point says that interest payable on the borrowed loan can be claimed. Okay, so that is what I have done over here under this deduction. Under section 24 subsection B, interest on loan, we are claiming. That means we are deducting from this net annual value. Okay, so the first point is quite self-explanatory. The second point says that interest payable on fresh loan taken to pay the original loan is also admissible as deduction. So basically what this point is saying is, basically for example, if the assessee has taken a loan originally, okay, but this original loan's rate of interest is 10%, okay, and he has taken, so let's read it again, interest paid on fresh loan taken to pay the original loan is also admissible as deduction. So if the assessee has taken a loan and the original loan was at 10%, okay, so what he is doing here now, he has got an offer from a bank that take a loan, okay, from us at the rate 8% and we will pay off your old loan, original old loan, will pay off it entirely and you take our this 8% loan and interest will be payable at 8%. So that means this is a benefit for the assessee, because earlier he was paying 10% rate of interest on the loan and now he has to pay only 8% interest. So basically the assessee will shift and he will ask this new bank to pay off this old loan, okay, and this new loan, whatever he is substituting against the original loan, and whatever interest will be payable on this new loan will also be allowed as deduction under section 24. So that is what it is written over here. Interest payable on fresh loan taken to pay the original loan is also admissible as deduction. I hope this is quite clear. Third point says that interest taken for construction of house property, then the interest payable till before the previous year in which construction is completed, such interest will be allowed in 5 equal installment till 5 previous year construction of the house property to be completed within 5 years from the date of taking the loan. So you all might have not understood anything from this point number 3. So again, let's come back over here. Let's take a new page. The point number 3 is trying to say that if an assessee, okay, has taken a loan for construction, okay, taken a loan for construction of house property. So you all might be aware that construction of the house property takes a period of more than 1 year, okay. I hope you all are aware of that, okay. So if an assessee has taken a loan for the construction of a house property, okay, and this loan was taken in the financial year 2016-17, okay, and the house property got constructed in the previous year 2019-20. Interest paid for the construction of the house property, then the interest payable till before the previous year in which construction is completed, such interest will be allowed in 5 equal installment till 5 previous year construction of the house property to be completed within 5 years from the date of taking loan. So basically, if an assessee wants to construct, okay, construct house property and he has taken loan, okay, taken loan, the house property should be constructed within a time frame of 5 years, okay, max. I hope this is quite clear. So that is what here in bracket it was saying as construction of the house property to be completed within 5 years from the date of taking loan. So here in the first year the assessee has taken the loan until the 5th year the construction gets completed, then only this interest will be allowed. How it will be allowed? Let's understand it. So for example, in the previous year, that is 2016-17, loan of rupees 50 lakhs at the rate 10% per annum was taken. So that means the loan of 50 lakhs was taken for the construction of house property at the rate 10% per annum interest. Okay, house property got completed in the previous year 2019-20. House property completed. Okay, so in the previous year 2016-17, okay, if the loan is taken on 1st April 2016, that means for the entire year, that is the financial year 16-17, the entire interest will be payable. So the interest for the previous year, so I'll write over here, interest for the previous year 2016-17 is rupees 5 lakh. How come I calculated 5 lakh? On 50 lakh, 10% is 5 lakh. Okay, for the previous year 2017-18, 2018-19 and 2019-20. Okay, so basically if you can see, the house property is completed within 5 years only, but the interest will be charged, okay, in the previous years, that is in previous year 2017-18 also 5 lakh interest will be charged. Okay, and similarly in the previous year 18-19 the interest will be charged, okay, 5 lakh. Okay, and in the previous year 19-20 again the interest of 5 lakh will be charged. So basically what our point number 3 is trying to say, interest paid for the construction of the house property, then the interest payable till before the previous year, in which construction is completed. That means a construction got completed in the previous year, that means till before the previous year where the construction got completed will be clubbed. That means the total of this 3 years, which will come to 15 lakhs. Okay, this 15 lakhs interest will be allowed as deduction in the coming next 5 years. Okay, so that means this 15 lakhs will be divided by 5. So let's divide 15 lakhs divided by 5, which will be equal to 3 lakhs. Okay, so 3 lakhs will be allowed in the previous year 2019-20 along with 5 lakhs. Okay, this 5 lakhs interest he has to pay in the previous year 19-20 also. So 5 lakh interest plus 3 lakhs will be allowed as deduction under section 24. But there is some limit also that we will study. But for time being, you understand that in previous year, this entire 5 lakh will be allowed as deduction. So for example, understand that if the house property would have got completed on 31st January 2019, that means the house property would have got completed in the previous year, that is 18-19. So that means before this 18-19, that means before the date of completion or before the previous year in which the house property was completed, the above that previous year whatever interest has been charged on the loan will be clubbed together. That means the interest would have become 10 lakhs and it would have been divided by 5 lakhs and it would have been available for the upcoming next 5 previous year, that is in the previous year 18-19, previous year 19-20 and further 3 more previous year. I hope this is quite clear. So that is what our this third point is trying to say. The third point is trying to say that interest paid for construction of the house property, then the interest payable till before the previous year in which the construction is completed, such interest will be allowed in 5 equal installment till 5 years. That means such interest will be allowed. It means total interest. This total interest, if the construction of the house property gets complete in the year 2019-20, then this earlier 3 previous years total interest will be allowed as deduction in the 5 equal installments for the upcoming 5 previous year. I hope that is quite clear to you all. So I hope this particular point is quite clear, but when we will solve an illustration from the study material, that time this particular point will be much clear. Okay, so the point 4 under section 24 says that interest related to the year of completion of the construction can be fully claimed irrespective of the completion date in the previous year. So basically 3 and 4 points are combined together only, and we have already understood this part over here, because in the previous year 2019-20, when the construction gets completed, earlier of that year whatever interest the assessee has paid will be clubbed and will be divided by 5 and will be distributed in the 5 previous year. Okay, such interest will be allowed in upcoming 5 previous year, but in the previous year in which the construction gets complete, the entire amount of the interest will be allowed in the previous year 1920 only. So that is what this point is saying. Interest related to the year of completion of the construction can be fully charged irrespective of the completion date in that previous year. So for example, if the completion gets complete on 30th March 2020 also, it will be considered as the house property got constructed in the previous year 1920 only. So earlier previous years interest will be clubbed, and this interest of 5 lakh will be entirely allowed as deduction in the previous year 1920 only. I hope this is quite clear to you all. And the next point, that is point 5, interest on the loan taken to pay the interest of the original loan will not allowed as deduction. So what is this point? So basically understand, 15 lakhs interest has been already accumulated and more 5 lakh interest is getting added. So you don't have sufficient money to pay off the interest, and you have taken the loan in order to pay off the interest. So on such loan taken to pay off earlier loan interest, okay. So on this loan, again the assessee has to pay interest. So whatever interest on this loan which he has taken to pay off the earlier loan interest only, not the principal, only interest, will be not allowed as deduction under section 24. That is what this point 5 is saying. So let's revise section 24. Okay, point 1 under section 24 says that interest payable on borrowed loan can be claimed. Point 2 says that interest payable on fresh loan taken to pay the original loan is also admissible as deduction. Point 3 says that interest paid for construction of the house property, then the interest payable till before the previous year in which the construction is completed, such interest will be allowed in 5 equal installments till 5 previous year. Construction of the house property to be completed within 5 years from the date of taking loan, then only the clubbing of the interest, okay, then only this clubbing of the interest and dividing it by 5 and allowing it to 5 previous year will be allowed. But if the construction is not completed up to 5 years also, or it has taken more than 5 years, then this will not be allowed in 5 previous years, okay, upcoming 5 previous year. I hope this is quite clear. Fourth point is that interest related to the year of completion of the construction can be fully claimed irrespective of completion date in that previous year. So simply it is talking about this point only, okay. Then fifth point is that interest on loan taken to pay interest of the original loan will not be allowed as deduction under section 24 over here. I hope this is quite clear. We have studied this section 24 allowability, but we have not studied the maximum limit, okay. So when we will study this maximum limit, that time I'll be able to explain you all why a self-occupied house property will incur a loss, and even if he has not rented or given such house property on rent, okay. Okay students, so now we will understand interest on loan. Basically what this chart is about, this chart is about the maximum limit, okay, maximum limit of what? Maximum limit of deduction that is allowed under section 24 subsection B. I hope this is quite clear. So basically we have studied under section 24 that if an assessee has taken a loan, then the assessee will pay an interest on the loan. Then whatever interest such assessee is paying on the borrowed loan will be allowed as deduction under section 24 subsection B. I hope this is quite clear. But we did not study the maximum limit, okay. So here in this chart we will study the maximum limit. I hope this is quite clear. So if an assessee has taken a loan, okay, and such loan is taken for LOP or DLOP, that means the loan has been taken and it is utilized for let out property or deemed let out property. If such loan is taken for purchase or construction of such LOP, that is let out property or deemed let out property, or such loan has been taken for the renovation or repair of such let out property or deemed let out property, then whatever the interest that the assessee will pay on such loan, then the 100% of the interest will be allowed as deduction, okay, under section 24 subsection B, okay. I hope this is quite clear. So our first part of this chart, that is let out property and deemed let out property, is complete, okay. So the trickiest part in this chart is SOP, but the trickiest part is also a simple part, okay. But don't worry, I have made it simple for you all, okay. So let's understand that if an assessee has taken a loan for SOP, okay, and such loan has been taken for the purchase or construction of this SOP, and such loan has been taken before 1st April 1999, then the maximum interest that can be allowed as deduction under section 24 subsection B is rupees 30,000 per annum, okay. But if the loan which has been taken for the house property, that is self-occupied house property, for purchase or construction of such self-occupied house property, and such loan is taken after 1st April 1999, then the maximum interest that can be allowed as deduction under section 24 subsection B is rupees 2 lakh per annum. I hope this is quite clear to you all. But if the assessee has taken the loan for this self-occupied house property for the repairs and renovation of this self-occupied house property, then the maximum interest allowed under section 24 subsection B is rupees 30,000 per annum. So you all might be thinking that, okay, so is there a combination that if an assessee has taken a loan for SOP for purchase and construction as well as he has taken a loan for repairs and renovation, okay, so that means this 2 lakh plus 30,000 can be clubbed, and 2 lakhs 30,000 entire deduction, that is the maximum limit, can be allowed as deduction under section 24 subsection B? The answer is no, okay, because the aggregate limit under this subhead, under this part, so the aggregate limit under this part, that is the SOP's part, is maximum 2 lakh. That means the maximum amount of deduction under section 24 subsection B for interest on loan in case of a self-occupied house property is maximum 2 lakh. So that is what I have written over here in red. Okay, so let's revise this part only. Okay, here I have written number of owners. Ignore it for timing, because when the time will come to explain this part, I'll explain it to you all. But for timing, we need to understand the maximum limit first. So by now you all might have recognize that there is no maximum limit for LOP and DLOP in order to claim a deduction of interest on loan, but there is a maximum limit in order to claim a deduction on interest on loan for SOP. Okay, so if an assessee has taken a loan for SOP for purchase or construction of the self-occupied house property, and such loan was taken before 1st April 1999, then the maximum limit of interest that can be allowed as deduction under section 24 subsection B is rupees 30,000 per annum. But if the same loan is taken after 1st April 1999, then the maximum amount of interest that can be allowed as deduction under section 24 subsection B is rupees 2 lakh per annum. I hope this is quite clear. But if the loan which is taken for the self-occupied house property, and such purpose of the loan was repair and renovation of the self-occupied house property, then the maximum interest that can be allowed as deduction under section 24 subsection B is rupees 30,000 per annum. The aggregate amount that can be allowed as deduction under section 24 subsection B in case of a self-occupied house property is maximum 2 lakhs of interest. I hope this is quite clear. So now I think it is time to explain you this column. Okay, how a particular assessee, if having a self-occupied house property, then also can incur a loss. Okay, so understand this. If an assessee, okay, we'll take a blank page and understand it, and then we will move back to our notes and I'll put the figures over there. So understand that if Mr. B is our assessee, okay, he has taken loan for purchasing house property. Okay, he has no house property. Okay, he has taken loan of rupees 30 lakhs at the rate 10% per annum interest, okay, for purchasing the house property. I hope this is very much clear. Okay, then he has also taken a loan of rupees 5 lakh at the rate 10% per annum interest, okay, for repairs and renovation. I hope this is quite clear to you all. Okay, so after reading this example, okay, what we can identify is Mr. B is purchasing a house property and he has no house property. That means basically he has purchased this house property in order to stay in this house property. That means this house property will become SOP, that is self-occupied house property. He has taken a loan of rupees 30 lakhs at the rate 10% per annum interest for purchasing the house property. So basically the purpose of the loan was for purchasing the house property, and the loan has been taken after 1st April 1999. Okay, I'll write here after so that there will be no confusion. Okay, and the last point says that he has also taken a loan of rupees 5 lakh at the rate 10% per annum interest for repairs and renovation. So that means the total interest on loan Mr. we will pay in this following manner. Okay, so he has taken two loans. First loan was for purchasing. Okay, first loan was for purchasing house property and second loan was for renovation. Okay, so basically the loan for purchasing was 30 lakh and the loan for renovation was 5 lakh, and the interest that the assessee will pay is 30 lakhs into 10%, which is equal to 3 lakhs, and for renovation 5 lakhs into 10%, which will be equal to 50,000. I hope this is quite clear to you all. So that means the total amount of interest paid by Mr. B is equal to 3 lakh plus 50,000, okay, which is equal to 3 lakh 50,000. I hope this is very much clear. Okay, but the maximum limit allowed as deduction under section 24 subsection B is rupees 2 lakh if the house property is SOP. I hope this is quite clear. So that means irrespective the assessee has paid 3,50,000, okay, of interest in the previous year 1920 for purchasing of the house property as well as for the renovation of the house property, but the maximum interest that can be allowed as deduction under section 24 subsection B is rupees 2 lakh. So let's come to our note. Okay, here we will feed this detail. Okay, so by now you all have understood this is a self-occupied property. Okay, so that means the NAV will be 0 because since the assessee is self-occupying the house property, that means the NAV will be 0. He is not incurring any income from such self-occupied house property. Okay, but there is a deduction still available. Okay, deduction is available under section 25, but still the deduction is available. The deduction is available under section 24 subsection A, standard deduction at the rate 30% of NAV. Since the NAV is 0, that means subsection A will be also 0. That means under section 24 subsection A, standard deduction at the rate 30% of NAV will be 0. But the deduction under section 24 subsection B will be available. That is what I have written over here, and that's why I have put a bracket over here. So we will erase that bracket and we will feed a figure that is 2 lakhs over here. So this is the interest that is allowed as deduction. Okay, so basically here the final income from the house property will become negative 2 lakhs. Okay, so that means there is a loss from the house property, and this loss from the house property can be set off against any other different heads of income. Okay, I hope you all remember that we have studied in set off and carry forward chapter. So we have studied one more concept in set off and carry forward chapter that we will revise. Wait, I'll just open that PDF so that you all can refer that. So we have studied that over here. Okay, loss from house property. If in the previous year the loss that the assessee has incurred from house property, from that loss of house property, first set of loss up to rupees 2 lakh from other head, and then balance loss if any can be set off against the income from house property. I hope this is quite clear. So let's come back to the income from house property chapter's note. Okay, so by now very much clear that how a particular assessee, if he is having a self-occupied house property, then also can incur a loss. Basically this is given as a relief to an assessee. Okay, why? Because there are many a times possibility that, understand over here, assessee is there who is a salary person. Okay, and his salary is say rupees 15 lakhs per annum. Okay, and he has purchased house property for his own, okay, for his own use. Okay, basically he's a salaried person, he is working very hard and earning this 15 lakhs of income, and he has purchased a house property for his own use on loan. Okay, so if a 2 lakhs of interest is allowed as set off, that means his final income from salary will also get reduced. That means he has to pay a tax on 13 lakhs. I hope this is quite clear to you all by now. I hope you all are understanding why this part in our notes in the table was so much important and why I was stressing so much. Okay, so I hope you all have understood this part. Okay students, so now let's complete all the miscellaneous parts of this chapter, income from house property. The miscellaneous part that are pending is number of owners. This note is a miscellaneous part. This vacancy period is also a miscellaneous part. Section 23 subsection 5. And some important note as well as section 27 deemed ownership. We have already studied this concept in a chapter known as income of other person clubbed into the total income of the assessee. I hope you will remember this section. That time I have told you that while studying income from house property chapter, you will see this section again over there. I hope this is quite clear to you all. So let's understand this note and let's understand this point number 1. So what does this point number 1 says? If a house property is let out, that means given on a rent for half of the year and for rest half it has been self-occupied, okay, then municipal value, fair rent, expected rent will be taken for full year only. So basically this note will help us to understand two concepts, okay, the concept that this point is trying to say and a concept that is written over here, that is vacancy period. So for that we need to move to a blank page, okay. So I'll explain you with an example. For example, Mr. A is the assessee having a house property, okay, and has let out the house property for a period of 6 months, okay, and for rest 6 months there are two possibilities, okay. If an assessee, okay, if an assessee Mr. A has let out his house property for a period of 6 months and for the rest 6 months, there can be two possibilities. What are the two possibilities? Let's understand it. The first possibility is he may use the house property for his own purpose, okay. Simply he can use that house property as self-occupied house property, or he may keep the house property as it is and not use it as self-occupied property, and he is searching the new tenant, okay. So I hope you all are agreeing with these two possibilities. If an assessee is having a house property and he has let out his house property for a period of 6 months, and for the rest 6 months there can be two possibilities. He may use his house property on his own, that is, that house property will become SOP for 6 months, and he may keep the house property as it is and not use it as SOP, and he may search a new tenant, okay. I hope this is quite clear. So we will understand this first and then we will understand this, because this is basically known as vacancy period and this is known as the house property has been let out only, okay. So let's understand this case 1, okay. So in order to understand the case 1, we will take some example that 6 months actual rent was rupees 12 lakhs, okay. This is for 6 months, but the municipal value, fair rent and the standard rent per annum as found out is rupees 10 lakhs, rupees 11 lakhs, rupees 12 lakhs. So you all might be thinking that actual rent is way higher, okay, way higher. So that is none of our concern, okay. So if you might be thinking that this municipal value is for per annum, so we need to bifurcate this per annum into 6 months. So the answer is no. We have to take this municipal value for the entire year only, that is for per annum basis only, irrespective for how many number of months the assessee has let out his house property for. If for example over here, instead of this 6 months, okay, if the assessee would have let out the property for 11 months and for that last 1 month, if he would have used that house property for his own purpose, that means he would have used that house property as self-occupied house property for last 1 month, then also this case would be applicable. That means the municipal value, the fair rent, the standard rent will be taken for the entire year only, for irrespective case, okay. Even for the vacancy period also, assessee the assessee has to take the municipal value, fair rent, standard rent for the entire year in order to calculate GAV, okay. I hope this is quite clear to you all by now, okay. So irrespective if the assessee is following this case 1 or this case 2 of the vacancy period, the municipal value, the fair rent, the standard rent will be taken for the entire year only, irrespective for how many number of months the assessee has let out the house property. I hope this is quite clear to you. But in this vacancy period, there is a certain formula that I have written here on the first page that we need to study. So I hope you all have understood this case one, that if an assessee has let out his house property for any number of months, that means out of this 12 months, for any number of months, he has let out house property, the municipal value, fair rent, standard rent will be taken for the entire year irrespective of how many number of months he has let out the house property for. I hope this is very much clear to you all. Okay, so that means this point number 1 of the note comes to an end over here. The point number 2 of this note says that if a house property is partly given on rent, then such property will be considered as having two house property. Okay, so don't worry, I know I have not taught you this part. Okay, just be patient. Let's understand point number 2 and then we will understand this part. Okay, so point number 2 says that if a house property is there, okay, and if such house property is having 2 floors, okay, or say 3 bedrooms, okay, out of this house property, okay, if the house property is having 2 floors, first floor is self-occupied by the assessee and ground floor is let out by the assessee. And similarly for 3 bedrooms case, 2 bedrooms are self-occupied by the assessee and 1 bedroom is let out by the assessee. So what has to be done? So basically the entire house property will have a municipal value, will have a fair rent, will have a standard rent, and actual rent will be the rent that the assessee is actually received. So basically this municipal value, fair rent, whatever will be given for the house property, we have to simply write it. For example, if 10 lakhs is given, okay, and fair rent is given 11 lakhs and the standard rent is given 12 lakhs. So if the house property is having a 2 floor and there are 2 identical units, that is first floor and ground floor, okay, so what can be done is, since the only ground floor is been let out, that means half of the property is been let out, so the municipal value, fair rent and the standard rent will be divided into, okay, divided into whatever the final figure that we will find out, that is 5 lakhs, 5 lakh 50,000, okay, and this 6 lakh, this is the per annum municipal value, fair rent or standard rent for the house property, this house property for the ground floor. I hope this is quite clear. So this 5 lakh per annum is for the entire 12 months again. Okay, so basically we have to bifurcate the municipal value, fair rent, standard rent in case the house property which is a single unit, but in this single unit also the assessee has given a part of that house property as a rent. Okay, so how to calculate that municipal value, fair rent, standard rent? We have to calculate the municipal value, fair rent, standard rent as per the portion of the house property that has been given on rent. I hope this is quite clear. So let's take a 3 bedrooms case example. So in case of a 3 bedroom example, here the entire house is having 3 units in total. 2 units are being self-occupied and 1 unit has been let out. So that means we have to find out the 1/3 part of the house property. So that will become the municipal value and the fair value and the standard rent for that house property. So we will find out the 1/3 portion, okay, and finally whatever the amount will derive, it will be the per annum amount, and the actual rent whichever has been taken will be compared with this all. I hope this is quite clear to you. So that is what this point number 2 is saying. So don't worry, whatever I have explained it to you over here, I'll solve an illustration for this part as well as for this part also. That time you will come to know whatever I have taught. Okay, so just don't worry about that. So now let's come back to our this part, that is vacancy period part. So what we have studied over here, if Mr. A is an assessee having a house property and has let out the house property for a period of 6 months, and for the rest 6 months he has kept the house property as it is and has not used the house property as self-occupied property, okay, and he is searching for the new tenant. That means he is not taking the benefit of this property for the rest 6 months. So government has given a relaxation. So what the relaxation is, come into our notes on the first page. What they are saying is, actual rent will be taken for 6 months. Okay, the assessee will be receiving the actual rent for the 6 months, and vacancy period is for the 6 months, that is for the rest half of the year. And if this total is greater than or equal to the expected rent, that means actual rent plus vacancy period, that means 6 months actual rent whatever he is receiving, that same only he will receive for that vacancy period also for the remaining 6 months. The entire total of this two, if it is greater or equal to expected rent, then the gross annual value will be equal to the actual rent. So this is a relaxation given if he is not using his let out property as self-occupied house property for rest period of the year. I hope this is quite clear to you all by now. But if the actual rent plus vacancy rent is less than or equal to expected rent, then gross annual value will be equal to expected rent that we have calculated in our table minus vacancy loss. So let's understand it with an example. Okay, so Mr. A, okay, has given house property on rent, okay, for 12 months, okay, but the tenant left the house property after 6 months, okay. So the house property is vacant for next 6 months of the year, okay. The assessee is not using such house property, okay. I hope this is quite clear. So basically 12 months actual rent was rupees 12 lakhs per annum. That means for 6 months he is receiving the actual rent, okay. This was the rent that the assessee was thinking he will receive, okay. But since the property was rented only for 6 months, because by the half of the year the tenant left the house property, and the rest half of the year the property remained vacant because the assessee was searching the tenant, he did not found a tenant. So that means that 6 months actual rent is equal to rupees 6 lakhs annum. I hope this is quite clear. And vacancy period rent is equal to rupees 6 lakhs only, okay. 1 lakh per month the rent is there, so you can understand from this over here only 1 lakh per month is the rent of the house property, but the tenant only used the house property for 6 months, so the vacancy period rent is 6 lakhs and the actual rent for the 6 months is 6 lakhs, okay. So now we will calculate, okay, now we will have to calculate GAV. In order to calculate GAV we need to find out expected rent, okay. So in order to find out expected rent we need to have municipal value, fair rent, standard rent. So municipal value, fair rent, standard rent are as follows: 10 lakh, 11 lakh and 12 lakhs, okay. So you don't need to divide this into 6 months and find out the value of the municipal value for 6 months, that is it will become 5 lakhs and this will become 5 lakh 50 and this will become 6 lakhs. No, we don't need to do that. We have to keep as it is for entire year, okay. So how we will calculate the GAV in case of a vacancy period? So we will calculate GAV in this following manner: municipal value, fair rent, okay, whichever is higher, plus standard rent will give us expected rent. So whichever is higher, whichever is lower, standard rent, expected rent, then actual rent, then GAV, okay. So here the ideal formula for this finding GAV was expected rent or actual rent, whichever will be higher will become our GAV. But in case of a vacancy period we don't need to follow this formula, okay. So what formula we need to follow, we will see. Municipal value is 10 lakhs, okay, and fair rent is 11 lakh, whichever is higher of this two is 11 lakhs, okay, and standard rent is 12 lakh. Out of this two, that is 11 lakhs and 12 lakh, whichever is lower is 11 lakhs, okay. So we don't need to write a actual rent figure over here, okay, because we need to apply that formula, okay. Vacancy period formula. What is the vacancy period formula? Says GAV will be equal to actual rent, okay, if actual rent plus vacancy period rent is more than equal to expected rent, then GAV will be equal to actual rent. I hope this is quite clear to you all. So we will see actual rent was how much? 6 lakhs. Okay, and the vacancy period rent was also 6 lakhs. So the expected rent that we have calculated is 11 lakhs. So we will write here 11 lakhs. So as you can see, this is greater than this expected rent. So we will write here greater. So that means our GAV will become actual rent only. So the actual rent is only 6 lakhs. So irrespective, we will not put a figure of actual rent over here and we will put GAV's figure straight over here, that is 6 lakhs. That is what we have calculated with this formula. But if the case would have been actual rent plus vacancy period rent is less than expected rent, then the formula would have been expected rent minus vacancy period rent. Okay, so that would have become our GAV. I hope this is quite clear. So that is what we have studied here. I hope this is quite clear. So I have written a note also over here. Vacancy rent means the let out house property vacant for a part of the year and because of which the actual rent is lower and such house property is not occupied by the owner. I hope this is quite clear. So by now this note is complete and this vacancy period concept is complete. I hope this is quite clear to you all. Okay, one more concept I want to teach you all that is not written in the notes, okay, but it is given in the format. Okay, in the format book, if you come to our format book, after this first table I have written actual rent. Okay, number of months into rent paid minus number of rents not received into rent per month. Okay, so what is this actually? So let me explain you with an help of an example. Okay, Mr. A, okay, has let out his house property for 12 months. Okay, the rent for 12 months is rupees 15 lakhs per annum. Okay, or we will change it to 24 lakhs per annum. Okay, so basically Mr. A, he has let out his house property for 12 months and the rent for 12 months is 24 lakhs per annum. That means 2 lakh per month the rent is being charged. Okay, the tenant has not paid the rent for last 1 month. Okay, and the assessee has made all the efforts as per rule 4 of income tax rules 1962. So I have written this part in red. Why I have written this part in red, I'll explain you, don't worry about that. The tenant has not paid the rent for the last 1 month and the assessee has made all the efforts as per rule 4 of income tax rule 1962 in order to recover such last 1 month's rent. So in this case, how GAV will be calculated? GAV will be calculated based on municipal value, fair rent, standard rent. The municipal value given in the question is 20 lakhs, 21 lakhs, 20 lakhs 50,000. So basically the question has given all this detail of municipal value, fair rent, standard rent. Out of this we have to calculate the expected rent and then we have to compare the expected rent with the actual rent. Whichever will be higher will become our GAV. So what is something special in this case? Something special in this case is Mr. A has let out his house property for 12 months and per month's rent is 2 lakh per annum. The tenant has not paid the rent for last 1 month. That means that assessee Mr. A has not received last 1 month's rent. That means he has received only 22 lakhs rent. I hope this is quite clear. That is 11 months into 2 lakh. I hope this is quite clear to you all. Actual rent is equal to number of months into rent per month. So that means as per the contract, the number of months was 12 months and the rent per month was 2 lakh, equal to 24 lakh. But for the number of months, rent not received was 1 month, okay, and the rent per month was 2 lakhs. So 24 lakhs minus 2 lakhs comes to equal to 22 lakhs. So now let's find out the gross annual value. How we will find out gross annual value? We will find out gross annual value in this manner. We will not again bifurcate this municipal value, fair rent, standard rent up to 11 months, okay. We will take it per annum only as it is, okay. We don't need to pro rata it, okay. I hope you know what does pro rata means, okay. This all details are for per annum, that is for 12 months. We don't need to convert it into 11 months. I hope this is quite clear to you all, okay. So the municipal value, fair rent, whichever is higher, okay, whichever is higher compared to standard rent is compared to whichever is higher will give us expected rent, and then expected rent will be compared with the actual rent. So we will write over here municipal value is 20 lakhs, okay, fair rent is 21 lakhs, whichever is higher of this two is 21 lakhs, okay, and then standard rent is 20 lakhs 50,000, whichever is lower of this two is 20 lakhs 50,000, okay, and the actual rent is 22,000. So whichever will be higher, actual rent, how we derived? Actual rent we derived in this manner, 24 lakhs minus 2 lakhs, which is equal to 22 lakhs, okay. So that means our GAV will be equal to expected rent or actual rent, whichever is higher. So whichever is higher is 22 lakhs. So you all might be thinking why I have written this rule 4 of income tax rules 1962 in red. Because if any tenant is not paying rent to the assessee, then this assessee has to take help of rule 4. In rule 4 they have given certain things that an assessee can do in order to receive his rent. Simply what an assessee will do, if the tenant is not giving him a rent, he can file a police complaint, or he may ask the tenant to vacate the house property, okay, and the assessee can file a legal case against the tenant, okay. So basically this is rule 4, okay. Basically this is rule 4 that income tax has said. If an assessee, okay, has given an house property on rent and the tenant is not paying the rent to the assessee, and if the assessee has followed all this process given in rule number 4, then the rent that has not been received by the assessee can be allowed to be reduced from the actual rent, okay. I hope this is quite clear to you. Actual rent simply means 12 months, okay. 12 months into the per month rent and finally the entire year's rent. I hope this is quite clear to you all, okay. So now let's understand this number of owners part, okay. This is also very simple, but in order to explain you this number of owners, I have to take an example, okay. So again let's come to a blank page, okay. For example, Mr. A and Mrs. A have taken a house property on loan, okay, and the house property is used by both of them. So this means that the house property is a self-occupied house property. So the loan whatever they have taken, Mr. A and Mrs. A, the interest on the loan will be allowed as deduction, okay, under the head income from house property under section 24 subsection B. I hope this is very much clear to you all. So let's read the example again. Mr. A and Mrs. A have taken a house property on loan and the house property is used by both of them, okay. So we don't need to find out the gross annual value and then the net annual value, okay. We need to simply find out the interest on loan, okay, for under section 24 subsection B, because this will be allowed as a deduction, okay. and then finally this assessee, Mr. A and Mrs. A, will incur a loss, okay, will incur a loss, and this loss can be set off against other heads of income. I hope by now you all have understood this part, okay. So let's see that. So the loan taken is of rupees 50 lakhs, okay, and the interest is at the rate 10% per annum. So they have taken a joint loan. Basically they are husband and wife. They have taken a joint loan of 50 lakhs, okay. So both of them are paying for the loan, okay. So the interest that will be paid is 5 lakh per annum. I hope this is very much clear. On this 50 lakh, the interest will be calculated. How much interest will be calculated? 10%, which will come to 5 lakh per annum. I hope this is very much clear. So that means the interest paid by the assessee is rupees 5 lakh per annum. So basically this 5 lakh interest is paid by both this assessees, that is Mr. and Mrs. A. Okay, that is the joint owners or the co-owners, we can say that. Okay, so if they are co-owners, they will divide this interest, okay, divide this interest into two, and each assessee's interest on house property will be equal to 2.5 lakh and 2.5 lakh. But the maximum limit, the max limit available for deduction under section 24 subsection B is rupees 2 lakh per annum if the house property is self-occupied house property. I hope this is quite clear. And now let's come back to our notes. Over here you can see I have written number of owners. So basically this maximum 2 lakhs, which is the aggregate criteria in order to take a deduction under section 24 subsection B, is rupees 2 lakhs, okay. So this will be allowed to per owner. That means this maximum 2 lakhs deduction will be allowed to each owner. That means Mr. A also will get a deduction of rupees 2 lakh when he is calculating his total income, okay, and Mrs. A, when she is calculating her total income, that time she will also get a deduction of this maximum 2 lakh, aggregate of 2 lakh if a loan is been taken for a self-occupied house property. I hope this is quite clear to you all. If you have not understood, then understand it in this manner. Mr. A will calculate his total income, okay, and Mrs. A will calculate her total income over here and over here, and they will get a set off, okay, set off from loss of house property of maximum 2 lakhs, okay. Because the interest that they are paying on that loan that they have taken for the house property is 2,50,000 each. That means Mr. A is bearing 2,50,000 cost and Mrs. A is also bearing 2,50,000 cost. So the maximum limit available, okay, under this Income Tax Act, under the income from house property head, if an assessee has taken a loan for self-occupied house property, is maximum 2 lakh for the number of owners. I hope this is quite clear to you all by now. This section 23 subsection 5 is very simple section, okay. This section says that the annual value of the house property or part of the house property shall be taken as nil only for a period up to 2 years from the end of the financial year in which certificate of completion of construction of house property is obtained from competent authority if the following conditions are satisfied, okay. The house property is held as stock in trade by the owner of the property, and the house property or any part of the property is not let during the whole or any part of the previous year. I hope you all have not understood a single word over here. Understand with a view in your mind as this is a builder, okay. If a builder of a property is there, okay, and he builds a entire house property, so understand it over here. This is a building, okay. 1, 2, 3, 4, 5, 6 ground. So basically this is a 6-floored building, okay, and there are 3 flats on each floor, okay. So as you can see from this example, a builder is there, okay, a builder is there, okay. He has built this house property Okay, this is a 6-floor house property. Okay, and on each floor there are 3 flats. Okay, including the ground floor. I hope this is quite clear to you all. So now let's read this again. The annual value, that means the yearly rent income. So how to read annual value? The yearly rent income of the house property or part of the house property shall be taken as nil only for a period of 2 years from the end of the financial year in which the certificate of completion of construction of house property is obtained from a competent authority if the following conditions are satisfied. So if the following conditions are satisfied, then only the annual value of the house property or part of the house property will be taken as nil. So basically understand that if a builder is building this building, okay, the builder will receive a certificate, that is a certificate of completion of construction of a house property from a competent authority. For example, understand RERA. RERA is a competent authority. A builder is building a house property. Okay, after building this entire structure, okay, RERA will give a certificate to a builder, that the construction certificate. Okay, it is known as completion of a construction of a house property certificate from a competent authority. After that certificate is given in a financial year, for example, house property got completed in financial year 2019-20 and RERA gave the certificate on 30th January 2020. Okay, so what does this point says? Basically this is a theoretical point. Okay, this is a theory point, but you need to know this for the purpose of MCQ. Okay, this section 23 subsection 5 says that the annual value of the house property or the part of the house property shall be taken as nil only for the period of 2 years from the end of the financial year. From the end of the financial year means from the end of this financial year, that is financial year 2019-20, more 2 years benefit. Okay, more 2 years benefit is given to this builder. Okay, why this benefit is given to this builder, that we will see right now. Okay, and why we will need to take the annual value of the house property or part of the house property as nil, that also we will see. Be patient. Okay, then from the end of the financial year in which the certificate of completion of construction of house property is obtained from a competent authority, and if the following conditions are satisfied. Okay, so basically you all understand this, there is a recession in a reality market. Okay, so just because there is a recession in the reality market, even after receiving this completion certificate from RERA, the builders are not able to sell the entire building, that means all the flats in this building. Okay, so there might be some flat that will be unsold in this building. Okay, this unsold flats will be considered as stock of this builder. Okay, that means the architect or the builder that has built this house property, that means the entire building. If some house property, that means the flats, are not sold, such flats will be considered as the stock of the builder. Okay, but if the builder is not taking this flats as his stock, then this particular section, that is section 23 subsection 5, will not be applicable. Okay, and if the builder is taking this flats as his stock and he is not renting any of these flats until that flats are being sold, then only this section 23 subsection 5 will be applicable. So this is what the condition is saying. The house property is held as stock in trade by the owner of the property, that means the builder. Okay, and the house property or any part of the property is not let out during the whole or any part of the previous year. So basically if you read over here, the annual value of the house property or the part of the house property shall be taken as nil, because if the assessee, okay, if the assessee who has taken this unsold flats as stock in trade, okay, if he is letting that house property on rent, then whatever income will be earned by such builder will be taken as the income of the assessee. Okay, but if he has taken such house property as his stock and he has not let out any of the property for any part of the previous year, then the annual value, that means the yearly rent income of the house property or part of the house property, shall be taken as nil only for the period, that means only for the period of up to 2 years from the end of the financial year in which the certificate of completion of the construction of the house property is obtained from the competent authority. That means, for example, if the assessee has received the completion certificate in the financial year 2019-20, that means from the end of the financial year till the next 2 years, that is up to 31st March 2023, the house property's NAV, that means net annual value, will be considered as nil. I hope this is quite clear to you all by now. So finally our section 23 subsection 5 comes to an end. Let's revise it. The annual value, that means the yearly income of the house property or part of the house property, shall be taken as nil only for a period up to 2 years from the end of the financial year in which certificate of completion of construction of the house property is obtained from the competent authority if the following conditions are satisfied. The house property is held as stock in trade by the owner of the property. So basically a builder can only keep the flats as a stock in trade, okay, and the house property, okay, or any part of the house property is not let out during the previous year, okay. That is what is given in this point number 2. I hope this is quite clear. Okay, so now let's read this important note. Okay, the important note says that first point, if a house property owned by an HUF, okay, so if an house property is owned by an HUF and is used by a partnership firm for carrying out of a business, and the karta and the members are partner in the firm in their individual capacity, then the income slash the notional income will be taxable in the hands of HUF under section 22. That means it will be considered as HUF has given this property on rent to the firm. Okay, so let's read this again. It is very simple. It is a very miscellaneous point. It may come for MCQ, that's why I have written it over here. Okay, so what does this point says? If the house property, okay, if the house property is owned by the HUF and is used by a partnership firm, okay, that means the partnership firm will be using that house property for carrying out business, and the karta of the HUF and the member of the HUF are the partners in the firm in their individual capacity, okay, then the income slash the notional income will be taxable in the hands of the HUF under section 22. I hope this is quite clear. So basically this is a theory, okay. So point number 2 is simply an extension of point number 1. So what does point number 2 says? But if the partner in the partnership firm being karta slash member in the firm in the representative capacity of HUF, then the same will be exempt in the hands of HUF. So what is this point saying? Okay, let's understand it over here. So if an house property is owned by HUF, okay, and this house property is used by firm, okay, that is the partnership firm, and the karta and members of HUF are partners in this firm, okay, but this karta and the members of the HUF are partner in the firm in representative capacity of HUF. That means this karta and members are representing the HUF. Then even if the house property owned by the HUF which is being used by the firm, the same will not be charged as income in the hands of HUF. So that is what this point is saying. But in point 1, what it was saying, if a house property owned by HUF is used by a firm, and in that firm the member and the karta are partner, but such karta and member are not in the representative capacity of the HUF, that's why the income or the notional income will be taxable in the hands of HUF. Basically this you will come to know when you come at CA final level. So I hope this point number 1 is clear. And point number 2 says that if the HUF is having a property, okay, and such property is used by the firm, and in that firm the karta and the members of the HUF are partners in this firm in the representative capacity of the HUF. That means in short the HUF is only using its property. The third point says that the rent income of a vacant land, okay, will be considered as income from other sources. That is what we have studied here, okay, when we were studying the property part, okay. Property must consist of any building or land apparent to thereto. That time I told you if only a land is been given on rent, then the rent income of the land will be considered in income from other sources. So that is what is written here. But if a land is attached with apparatus, that is building structure, then income from house property. I hope this is quite clear. If you want to copy this part, you can copy it, but I'll recommend do not copy it, because at your level This all questions will not be asked because there are many questions they have to ask from this income from house property chapter. For example, they have to ask how you will calculate gross annual value, how you will calculate gross annual value if there is a vacancy period. Okay, so don't worry about that. How you will calculate the interest on loan, okay, in case of a self-occupied house property. I hope this is quite clear to you all. Okay, so the last point that is remaining in this chapter, that is income from house property, is section 27, deemed ownership. So let's read it. You have already studied this, so you won't find it difficult. Okay, the first point says that if the assessee has transferred the house property for inadequate consideration, that means without any consideration to the spouse, then the assessee will be the deemed owner of such house property. And in that earlier chapter we have studied whatever income such wife or the spouse will receive will be clubbed in the income of the assessee who has transferred it. That means the transferor assessee. I hope this is quite clear. But here we will study an exception. The exception says that if such house property is transferred in an agreement to live apart, then spouse will be the owner of such house property, and any income earned by the spouse will not be clubbed into the income of the assessee who has transferred that house property. There also we have studied it. Okay, but here in little detail we are studying. Okay, so the agreement in live apart means, simple word is divorce. Okay, so do not think much about that. What does an agreement of live apart means? If two people who are married and they have decided to get divorced, so there is a provision in the law that if an husband and wife get split, okay, then the husband has to give a part of a property to his wife. Okay, so that's why this particular exception is given. Okay, because it is covered under some law. Okay, where if an husband and wife splits up, the husband has to give some property to the wife. So if such transfer is there, then the wife will be the owner of such property. Okay, even if it is for inadequate consideration. I hope this is quite clear. And the second point is, if the assessee has transferred the house property for inadequate consideration to minor child, then the assessee will be the deemed owner of the house property, and the income that has been derived by the minor child will be clubbed into the income of the assessee. I hope that also we have studied in that chapter. But there is an exception. If such house property is transferred to minor daughter who is married, then such assessee will not be the owner of such house property. That means the assessee, the transferor assessee who is transferring the house property to the minor daughter who is married, will not be the owner of such house property. I hope this is quite clear. Okay students, so please come into our format book, okay, of income from house property chapter. Basically I have made a format in this format book. This format will be very useful for your exam point of view, but I'll not explain you this format blankly. I'll rather solve sums in this format book so that you can understand how effective this format is. Okay, and I have made a question that you can refer in your format book only. Okay, this question will cover few concepts together. Let me tell you which all concept will be get covered in this particular question. Come into our notes. Okay, section 22 will be covered. Okay, this entire table format will get covered. Okay, then vacancy period concept will get covered over there, as well as this section 24's point number 3 and point number 4 concept will also get covered over there. Then maximum limit of interest that can be allowed as deduction under section 24 subsection B will also get covered over there. Okay, and this note number 1 will also get covered over there. Okay, and municipal taxes concept will also get covered in that particular sum. Okay, and there is one new concept I have introduced in this question, so basically that you will come to know over here. Okay, it is not very difficult. I'll just explain it to you over here only and you will understand it. It is very simple. It will hardly take 5 minutes. Okay, so let's read the question now. Okay, so Mr. Ashish, aged 55 years, is a resident, ordinary resident. Okay, so that means Mr. Ashish is a resident, ordinary resident, and his age is 55 years. Okay, Mr. Ashish is a salaried person. His income from salary is rupees 15 lakh computed. So that means his income from salary is given to us. We don't need to compute his income from salary. I hope this is very clear. Mr. Ashish has 3 house property, details of which are as follows. The first house property, okay, the status of the first house property is let out house property. The status of house property number 2 is let out house property, and status of house property 3 is self-occupied house property. I hope this is quite clear. So the actual rent detail for 1 month is given for this house property 1, house property 2. For house property 3 there is no need of actual rent detail. I hope this is quite clear to you all. Okay, So the actual rent for 1 month for a house property 1 is 1 lakh and for house property 2 is 1,20,000. Number of months for which the tenant did not pay the rent. Rule 4 applies. That means here we can apply the concept that we have studied in our format book only after the end of the first table over here. Okay, if you remember, we have studied this concept. Okay, so that is what this rule 4 is about. Okay, so what the question is saying, the rule 4 will be applied and the number of months for which the tenant did not pay the rent was 2 months in case of house property 1 and 1 month in case of house property 2. Okay, property vacant for the number of months. House property 1 was vacant for 3 months. That means the tenant left the house property. The assessee, Mr. Ashish, did not found any new tenant. Okay, so we will apply this formula. Okay, that we have studied in our notes. Okay, this formula, I hope this is quite clear to you all. Then municipal value detail is given, fair rent detail is given, standard rent detail is given for house property 1 as well as for house property 2. Municipal taxes paid by the owner for house property 1 and for house property 2 is 10% of MV. MV stands for what? Municipal value. Okay. Then the loan taken for the house property details are given. The loan taken for the house property 1 is 30 lakhs at the rate 8% per annum and the loan interest amount is 2,40,000. I hope this is quite clear to you all. Then the loan taken for the house property 2 is 35 lakhs at the rate 8% per annum and the interest paid is 2,80,000. And for the house property 3, that means the self-occupied house property, the loan was taken of 40 lakhs at the rate 10% per annum. Therefore, the interest is equal to 4 lakh. I hope this is quite clear to you. So here a new detail of a house property is given. So basically earlier there was 3 house property detail given, but here again a new house property detail is given. So what is that? Let's understand it. Mr. Ashish had taken a loan for construction of a house property on 1st April 2016, that is financial year 16-17. The house property got completed on 1st May 2019, that is in the financial year 1920. So this is our previous year also 2019-20. The constructed house property was let out from 1st June 2019 at the rate 1,50,000 per month. Municipal value, fair rent, standard rent details are given and municipal taxes 10% of the MV, that is the municipal value paid by the tenant. So you know by now this will not be allowed as deduction from the GAV. That is what we have studied in our notes. Come back to our notes in this municipal taxes. Okay, it is allowed on paid basis and it is allowed as deduction only if paid by the owner, okay, or borne by the owner. Since in this question it is paid by the tenant, this 10% of the municipal value will not be allowed as deduction from the gross NAV for this constructed house property. I hope this is quite clear. Loan for the construction of the house property taken by Mr. Ashish in 2016-17, that is the financial year 16-17, was rupees 50 lakhs at the rate 10% per annum. So basically this part is relating to this section 24, point number 3 and point number 4. Okay, so if you remember while we were studying section 24, that time I told you point number 3 and point number 4 I'll explain you with an example. Okay, so basically this is that example. Then the last point says Mr. Ashish received arrears, that is outstanding of rent for the previous year 2018-19 which was in dispute in the previous year 1920 of rupees 1 lakh. So let's read this again. Mr. Ashish received arrears of rent for previous year 2018 which was in dispute in previous year 1920 of rupees 1 lakh. So that means Ashish received this 1 lakh of outstanding rent which was receivable by him in the previous year 18-19. So what will be the treatment for this, that also we will see. Okay, so this is very simple part. Okay, do not take stress about this. Okay, calculate the total income of Mr. Ashish for the assessment year 2020-21. So basically now we will start using our format. Okay, so come into our format and firstly we'll write the name of the assessee, that is Mr. Ashish. Residential status of Mr. Ashish is resident, ordinary resident. Age is given of Mr. Ashish, so we will write his age 55 years. I hope this is quite clear to you all. Okay, so there are 4 house properties in all. Okay, house property 1, house property 2, house property 3 and the constructed house property which is also a let out house property. So we will come into our format. Okay, and we will write here, we will write over here house property 1 which is let out house property. We will write house property 2 which is also a let out house property, and then we will write house property which is constructed house property which is also a let out house property. Then we will write house property 3 which is self occupied house property. Okay, so we need to feed the details over here. So let's feed the details first of all primarily. So the details that we need to feed in our format was municipal value, fair rent, standard rent. Okay, so we will simply feed that detail first as it is. Okay, so come back to our format. The municipal value is 10 lakhs, the fair rent is 11 lakhs, okay, and the standard rent is 12 lakhs. I hope this is quite clear. And for house property 2, the details are the municipal value is 11 lakhs, okay, the fair rent is 12 lakhs, and the standard rent is 13 lakhs. In case of the house property that is constructed, we'll feed the details. It is 12 lakh, 13 lakh and 14 lakh. Municipal value is 12 lakh, 13 lakh and 14 lakh. I hope this is quite clear to you all. Okay, so now we will find out our expected rent with the help of this information given in the question. Okay, so formula says municipal value, fair rent, whichever is higher will become 11 lakhs. Okay, and whichever is higher versus standard rent, whichever is lower will become our expected rent. That means 11 lakh is our expected rent. Okay, so in house property 2, we will calculate in similar manner. Whichever is higher is 12 lakhs, okay, and whichever is lower over here is 12 lakhs again. So the expected rent in house property 2 is 12 lakh. In case of a constructed house property, whichever is higher is 13 lakhs, and out of this two, whichever is higher and the standard rent, whichever is lower, the expected rent becomes to 13 lakh. I hope this is quite clear. So now we need to find out the actual rent for house property 1. So let's come into our question and let's find out the actual rent for house property 1. For that, there are 3 details given in the question. That is, the actual rent for 1 month is rupees 1 lakh per month, okay. Number of month for which the tenant did not pay the rent, that is 2 months, okay, and property vacant for the number of months was 3 months. So understand it in this manner. Okay, I'll make a timeline over here. Okay, this is 1st April 2019, okay, and for the last 3 months, okay, that is from January to March, the house property was vacant. That is what our question is trying to say. So basically what is trying to say, property was vacant for the number of months, so last 3 months, that is from 1st January to 31st March, the property was vacant. That means the house property was given on rent for a period of 1st April to 31st December, okay, that is 31st December 2019, okay. Between this period, the tenant did not pay the rent for 2 months, okay. So the actual rent, okay, so the actual rent was received only up to 30th October, okay. For November and December, no rent was received from tenant. I hope this is quite clear. So that means our actual rent is equal to 1st April to 30th October. That comes to around 7 months. Okay, how come I'm saying 7 months? April, May, June, July, August, September, October. That is equal to 7 months. So for 7 months into 1 lakh is equal to 7 lakhs actual rent. Okay, since here vacancy period is there, so we need to find out GAV as per the vacancy period format that we have studied in our notes, okay, as we have studied over here, okay. So we will put that format over here. We will write over here gross annual value is equal to actual rent, okay, actual rent plus vacancy period rent if greater than equal to expected rent, then GAV will be equal to actual rent. I hope this is quite clear. So the actual rent is equal to 7 lakhs, okay, and the vacancy period is 3 months, okay. So 3 months into 1 lakh, 1 lakh, so which is equal to 7 lakhs plus 3 lakhs, okay. And the expected rent, from the format we will see the expected rent is equal to 11 lakhs, okay. So we will write that detail over here. Expected rent is equal to 11 lakhs. I hope this is quite clear to you all. Since you can see this side is not greater than the expected rent, then the formula will change, okay. We will write the formula here now. if the actual rent plus the vacancy period rent, okay, is less than equal to expected rent, then the GAV will not be equal to the actual rent, but the GAV will be equal to expected rent minus vacancy period rent. I hope this is quite clear. So that is what we have studied in this vacancy period formula, that the actual rent plus vacancy rent, if is greater than equal to expected rent, then GAV, that means a gross annual value, will be equal to the actual rent. I hope this is quite clear. But if the actual rent plus vacancy rent is less than equal to expected rent, then GAV is equal to expected rent minus vacancy loss. I hope this is quite clear. Vacancy loss simply means vacancy rent only. I hope this is quite clear. So let's move back to our format book. Okay, so we can see that this 10 lakhs is less than the expected rent. So the GAV, okay, so the GAV will be equal to expected rent is 11 lakhs minus vacancy period rent is 3 lakhs. So we will write that detail over here, 3 lakhs, and the GAV will be equal to 8 lakhs. I hope this is quite clear to you all. So finally our actual rent, will not write anything over here, we'll put a dash, or we will write working note number 1, and we will mark it over here as working note number 1. Okay, and the gross annual value we will write over here 8 lakhs. I hope this is quite clear to you all. So you can see that we have revised this formula also in this sum. I hope this is quite clear to you all by now. Okay, house property number 2, actual rent for 1 month is 1,20,000. Number of month for which tenant did not paid rent is 1 month. Okay, and the property vacant for the number of months is 0. So from this point we can ascertain that vacancy period formula we don't need to apply in house property number 2. Okay, let's come to our format book. Okay, and here on the next page we will write working note number 2. Okay, this is for house property number 2. We are calculating actual rent. Okay, so the actual rent will be equal to 11 months into 1,20,000 per month rent. I hope this is quite clear. So let's calculate it. Okay, 1,20,000 into 11 months is equal to 13,20,000. Okay, so the actual rent is equal to 13,20,000. These detail we need to feed it over here, 13,20,000. Okay, so whichever is higher of this two, that means the expected rent and the actual rent, will become our GAV. So our GAV is equal to 13,20,000. I hope this is quite clear to you all. This house property is related to the house property that is constructed. So for that also we need to find out the actual rent. Okay, so come back to our question. Okay, here they have given us the detail that Mr. Ashish has taken the loan for construction of house property on 1st April 2016. That means the loan was taken on this date. The house property got completed on this date, that is 1st May 2019. Then the constructed house property was let out from 1st June 2019 at the rate 1,50,000 per month. That means for 10 months the house property was rented. So let's calculate the actual rent for house property which is constructed. So we'll write over here working note number 3, house property constructed, and what we are calculating actual rent. So the actual rent for the house property constructed is 10 months into 1,50,000 per month, which is equal to 15 lakhs. I hope this is quite clear to you all. So here we will write 15 lakhs. Okay, and whichever will be higher of the expected rent and the actual rent, okay, will be considered as the gross annual value, so which is equal to 15 lakh. I hope this is very much clear to you all. So now let's calculate the municipal taxes from the details given in the question. Okay, so in the question they have given the municipal taxes are paid by the owner. For the house property 1, the municipal taxes value is 10% of the MV, that is the municipal value, and for house property 2 also 10% of the MV. But in case of house property that is constructed, the municipal taxes paid is 10% of the MV, but it is paid by the tenant. So that means for the house property that is constructed, municipal taxes will not be allowed as deduction to the assessee, that is our Mr. Ashish. I hope this is quite clear. So let's come back to our format, and 10% of MV. So the municipal taxes for house property 1 will be equal to 1 lakh, that is 10 of 10 lakh. I hope that is quite clear to you all. So the net annual value will be equal to 7 lakhs. I hope this is very much clear. And in case of the house property to the municipal taxes is equal to 10% of the MV, that is 11 lakhs. So the 10% of 11 lakhs is equal to 1,10,000. I hope this is also quite clear. So the net annual value of the house property 2 is 12,10,000. But in case of house property which is constructed, municipal taxes will not be allowed as deduction. So the net annual value will be equal to 15 lakh. I hope this is also very much clear to you all. And net annual value for house property 3 will be 0. I hope this is quite clear. Now we will make a deduction under section 24 on this net annual value. So deduction under section 24 is available in two parts, that is subsection A and subsection B. So as per subsection A, 30% of the NAV is allowed as standard deduction. So we need to calculate 30% of this each case. Okay, so let's calculate that. Okay, 7 lakhs into 30% is equal to 2,10,000. I hope this is quite clear to you all. For 12,10,000 into 30% is equal to 3,63,000. I hope this is also clear. For house property that is constructed, 15 lakhs into 30%, which is equal to 4,50,000. I hope this is quite clear to you all. So as we have studied in our notes, let's come to our note. As we have studied in this interest on loan chart, that in case of a LOP or DLOP, if a loan is taken and interest on such loan is paid, then unlimited interest will be allowed. So that is what the question is telling us. The assessee has taken the loan for this let out house property also, so this entire interest will be allowed as deduction. I hope this is quite clear. But in case of this self-occupied house property, up to 2 lakhs of the aggregate amount of the interest will be allowed as deduction. That is what we have studied in the notes over here. I hope you remember this. So now let's move back to our format and let's feed that detail. So interest on the loan in case of the house property 1, okay, that is a let out house property, is 2,40,000, and for house property 2 is 2,80,000. So we will just feed that details. 2,40,000 and 2,80,000. I hope this is quite clear to you all. And in case of the self-occupied house property, the maximum limit is 2 lakh. So income from house property in case of house property 3, that is self-occupied house property, is 2 lakhs. I hope this is quite clear. That is loss of rupees 2 lakhs. Okay, so now let's calculate income from house property 1, okay, which was let out house property. 7 lakhs minus 2,10,000 minus 2,40,000. Okay, so it comes to around 2,50,000. I hope this is quite clear. In case of house property 2, income from house property 2 is 12,10,000 minus 3,63,000 minus 2,80,000. Okay, which is equal to 5,67,000. I hope this is quite clear to us. So we need to calculate the interest that can be allowed as deduction under section 24 subsection B in case of house property that was constructed. So for that we have studied in this section number 24 that point number 3 and point number 4. Okay, so we need to apply these points now in our solution. So let's read the question again for house property that was constructed. Okay, so let's read the question. Okay, the question says that Mr. Ashish has taken a loan for construction of the house property on 1st April 2016. That means the loan was taken on 1st April 2016 and house property got completed in the financial year 1920. Okay, so we will write here financial year 1920. Okay, financial year 1819, financial year 1718, financial year 1617. So basically the loan was taken in the financial year 1617. Okay, and the house property got completed on 1st May 2019. I hope this is quite clear. So we will feed the details of the interest on loan. Okay, so the interest on the loan that will be paid by the assessee is 50 lakhs into 10%, which will be equal to 5 lakhs per annum. Okay, so we'll just write that details. 5 lakhs for the previous year 1718 also the loan is there, so the interest will be 5 lakhs. Okay, so in the previous year 1819 also the loan is there, so in the previous year also the interest will be paid of 5 lakhs. And in the financial year 1920, that is our previous year 1920, that time also 5 lakhs interest will be paid. Okay, so I have written all the interest that the assessee will pay from the date of taking of the loan, okay, till our end of the previous year. Okay, so in the each year he is paying 5 lakhs of interest. I hope this is quite clear. So let's read this section 24 again so that things will get revised as well as you can understand what I am doing. The point number 3 is saying interest paid for construction of the house property, then the interest payable till before the previous year in which the construction is completed, till before the previous year. So that means come back to our format book. So here up to here, okay, up to here whatever the interest the assessee has paid will get clubbed. Okay, that is what this point is telling till here. Okay, interest paid for the construction of the house property, then the interest payable till before the previous year in which construction is completed, such interest will be allowed in 5 equal installment till 5 previous year. That means let's come back to our format book. The total of this 3, which is equal to 15 lakhs, okay, divided by 5, which is equal to 3 lakhs. This 3 lakhs amount will be allowed in the upcoming 5. So this 3 lakhs will be allowed for the upcoming 5 previous years. That means see over here, in this previous year 1920 also this 3 lakh will be allowed, in the previous year 2021 also it will be allowed, and similarly for more 3 years this 3 lakhs will be allowed as deduction. That means this entire 15 lakh is divided into 5 previous years. I hope this is quite clear to you all. So that is what is given in this point number 3. Okay, constructed house property to be completed within 5 years from the date of taking loan. So in our question the house property is getting completed within 4 years only, so that is within the limit of 5 years. I hope this is quite clear. So now let's read the point number 4. Point number 4 says that interest relating to the year of completion of the construction can be fully claimed irrespective of the completion date in that previous year. So that point is saying since our house property got completed on 1st of May 2019, then this 5 lakh will be allowed as deduction, okay, under section 24 subsection B 100% in the previous year 1920 along with this 3 lakhs of interest. I hope this is quite clear to you all. Okay, so in all the deduction available under section 24 subsection B for the previous year 1920 is equal to 5 lakhs, okay, plus 3 lakhs. Okay, I hope this is quite clear to you, which is equal to 8 lakhs. Okay, so let's take this our calculation. Wait, let me take this calculation. Okay, so let me cut this calculation and take it over here. Okay, working note number 4. Working note number 4. House property constructed deduction under section 24 subsection B. I hope this is quite clear to you. So here we will write 8 lakhs. Okay, 8 lakhs is allowed as deduction. I hope this is quite clear to you. So let's calculate the income from the house property that was constructed. 15 lakhs minus 4 lakh 50,000 minus 8 lakhs, which is equal to 2 lakh 50,000. I hope this is quite clear to you all by now. Okay, so as you can see there is a loss in this house property number 3, which is a self-occupied house property. So this 2 lakhs can be set off against the any other head, okay, against any other head of income in the first year. So that means this 2 lakhs can be set off against the income of salary. Okay, we have already read in our question that Mr. Ashish, age 55 years, is a resident, ordinary resident. His salary person, his income from salary is 15 lakh, which is computed. So out of this 15 lakhs, that loss of rupees 2 lakh can be set off. Okay, I hope this is quite clear to you all. So if you can see, the income from the house property, total income from the house property is 2 lakh 50,000, okay, plus 5 lakh 67,000 plus 2 lakh 50,000. Okay, that comes to around 10 lakh 67,000, and this 2 lakhs will be set off against income from salary. This will get set off. I hope this is quite clear to you all. Okay, so this was the thing. Okay, but we have skipped one part that we have to consider. Okay, so we have calculated the total income from the house property. Okay, but we have not considered one thing that we had to consider. Okay, so which was that one thing? This part, as I told you, okay, this part says that Mr. Ashish received arrears of rent for the previous year 18-19, which was in dispute in the previous year 19-20 of rupees 1 lakh. So that means Mr. Ashish received arrears in the previous year 19-20 of rupees 1 lakh, and this arrears was for the previous year 18-19. Okay, so that means on this 1 lakh in the earlier year, that means the previous year 18-19, okay, this 1 lakh was not considered in the total income, okay, while calculating income from house property. I hope this is quite clear to you all. So basically on this 1 lakh, the deductions available under section 24 was not available on this 1 lakh, so we can calculate the deductions. Okay, so here I'll write working note number 5. In working note number 5 we will calculate income on arrears of rent received in previous year 19-20. So in the previous year, arrears of rent received is 1 lakh. Okay, so this will only become our NAV. Okay, so if we have calculated NAV, we will reduce deductions available under section 24, subsection A, standard deduction at the rate 30% of NAV, and subsection B says that interest on loan. I hope this is quite clear to you all. Let's calculate the income from this arrears of rent. Okay, so the standard deduction is 30% of the NAV. Okay, so we will write over here 30,000, and here interest on loan will be dash, and finally income from arrears of rent is equal to 70,000. That means our total income now from income from house property will include this as well as this 70,000. Okay, earlier we have calculated 10,67,000. You can see it over here, and here again we will add one more 70,000, and finally we will get our income from house property, that is 11,37,000. So finally, how to present this part? So finally we will simply present in this manner: total income of Mr. Ashish, income from salary is equal to 15 lakhs. Okay, and losses that can be set off against this income from salary is loss from self-occupied house property number 3, which was 2 lakh, so we will reduce that over here, and finally the income from salary will become 13 lakhs, and our income from house property will be in this manner: income from house property 1, house property 2, house property constructed, and arrears of rent. Okay, 2, 3, so which was 2,50,000, 5,67,000, 2,50,000, 5,67,000, and in case of house property constructed was 2,50,000, and arrears of rent was 70,000, and finally our amount came to around 11,37,000. I hope this is quite clear. So the total income, which is the gross total income, okay, gross total income 13 lakhs plus 11,37,000. I hope this is quite clear. So the final gross total income comes to around 24,37,000. I hope this is quite clear to all. Since the question has not asked us to calculate the income tax liability, we will not act smart and calculate income tax liability, because in order to calculate income tax liability, if the question has not given us the details of deductions under chapter 6A, then we can't find the net total income. Okay, and on the net total income only the income tax liability is calculated and not on the gross total income. But if you are assuming that the question has not given any details of the deduction, so the deductions are zero and the net total income is equal to that only, and on that you will calculate the income tax liability. So please don't do that, because read the question properly. So the question was saying calculate the total income. Okay, the question never said calculate the tax liability. I hope this is quite clear. So this is the final answer. Okay, I hope this is quite clear, and I hope you all enjoyed this sum also, because this sum was a very important sum. Okay, so if you want you can copy the sums. Okay, wait, I'll just zoom it little bit so that you can copy it. Please pause the video and copy it. I hope you all have copied this much. So if you want to copy the working notes also, please copy the working note number 1, 2 and 3. Okay, I hope you all have copied the working note number 1, 2 and 3 also. Copy the working note number 4. Okay, this part was little bit important. Okay, so I have explained that part also. Okay, I hope you all have copied working note number 4 and working note number 5 and calculate the total income of Mr. Ashish, and please copy this total income of Mr. Ashish also. Okay, so this is the final presentation. Do not copy all this. Okay, I hope you all have copied this much also, and the question is available with you. If you have seen the format book, by now you are aware that the question is available and this blank format was available. Okay, I hope this is quite clear to you all. So we'll solve two sums from the study material and then a chapter comes to an end. I hope this is quite clear to you all. Okay, so I have erased all the solution that I have made in my format. Okay, so let's come to our study material on page number 4.143, illustration 8. Okay, let's read this. Okay, and we have to compute the Ganesh's income from house property for the assessment year 2020-21 and suggest which house property should be opted by Ganesh to assess as self-occupied house property so that his tax liability is minimum. So basically here in this question there are 3 house property given. We have to select which house property should be DLOP. I hope this is quite clear. So see, let's read the question. Ganesh has 3 house property, all of which are self-occupied house property. The particulars of the house for the previous year 2019-20 are as under. Here we have studied not rented. Okay, if an assessee is having a house property and such house property are not rented, and if more than 2 house property are not rented, then out of this more than 2 house property which are not rented, we have to select any 2 with the highest annual value, which will become our SOP, that is our self-occupied property, and the balance will become DLOP, that is deemed let out property. I hope this is quite clear. So basically the entire question is on this part only. Okay, I hope this is quite clear. So let's read this. Ganesh has 3 houses, all of which are self-occupied. The particulars of the houses for the previous year 1920 are as under. House property 1 detail is given, house property 2 and house property 3's detail is given. Municipal value, the fair rent and the standard rent per annum details are given till year. So you can find out the GAV from here. Date of completion / purchase details are given. So we need to ascertain what importance are these dates are for solving our sum. Okay, but let's read the question. Municipal taxes are paid during the year is 12%, 8%, 6%. Since the question is not saying this percentage on which amount, so we have to assume on municipal value we have to calculate this 12%, 8% on this value and 6% on this value. I hope this is quite clear. Interest on money borrowed for repairs of the property during the current year 55,000. Okay, interest on the current year on money borrowed in July 2013 for purchase of the property was 1,75,000. So none of our property, that is house property 1, house property 2 and house property 3, none of the house property was constructed. All the house properties were purchased. Okay, so we don't need to calculate the interest under section 24 subsection B that we have studied in this part, that is point number 3 and point number 4. Since the house properties are purchased, we have to skip that part. Okay, so that particular point 3 and 4 will not form part of our solution. I hope this is quite clear to you all. So we have read the entire details given in the question. Okay, and we have to find out which house property will become our SOP or DLOP. I hope this is quite clear to you all. So let's move to our format and feed these details as it is given in the question. Okay, so I'll show you how to utilize our format in case when the question in exams ask you this kind of a question. Okay, so that's why this format was having this second table. Okay, so I'll show you that. how to utilize that second table also. We'll write the name of our assessee, that is Mr. Ganesh. Okay, residential status is not given, we will assume resident, ordinary resident. Okay, we will write here house property 1, house property 2, house property 3, and we'll put a cross over here because house property force detail is not given. Okay, so municipal value 3 lakh, 3,75,000, 3,50,000. So we'll just simply first learn simply to feed the details in the solution. Okay, 3,75,000, 3,50,000. Okay, then 3,60,000, 2,75,000, 3,60,000, 2,75,000, and 3,70,000. Okay, standard rent is 3,70,000. Okay, 3,30,000, 3,80,000, 3,75,000, 3,80,000, and the last figure is 3,75,000. I hope this is quite clear to you all. The question is saying Ganesh has 3 house properties, okay, and all the house properties are self-occupied. So that means we are finding out which property will become a DLOP. I hope this is quite clear by now. Okay, so we need to write in place of actual rent 0. Okay, that means nil. The actual rent is nil and we will write it nil over there. I hope this is quite clear to you all. And we need to find out our expected rent. So whatever will be the expected rent, it will be compared with the actual rent and then it will become our GAV. I hope that is quite clear to you all. Okay, so let's find out our expected rent. Okay, the expected rent will be calculated in this manner: municipal value and fair rent, whichever is higher. Okay, whichever is higher out of this two is 3,75,000. Okay, 3,75,000, and 3,75,000 will be compared with the standard rent. Whichever is lower out of this two will become our expected rent. That means 3,50,000 will become our expected rent, and that means our gross annual value will become 3,50,000. How come 3,50,000 compared with actual rent, that is nil, will equal to 3,50,000 only? So the gross annual value is 3,50,000. Municipal taxes details are given in the question, but we will calculate it later. First we will calculate GAV for all the 3 house properties. I hope this is quite clear to you all. The municipal value for the house property 2 is 3,60,000 and the fair rent for the house property 2 is 2,75,000. Whichever is higher of this two, okay, will be compared, and finally we will write the detail over here as 3,60,000. 3,60,000, whichever is higher, will be compared with the standard rent, okay, over here, and whichever will be lower of this two will become our expected rent, and expected rent versus actual rent, whichever is higher, will become our gross annual value. That means 3,60,000 only. I hope this is quite clear to you all. And for the house property, similarly we'll calculate higher of this two, which comes to 3,80,000, lower of this two comes to 3,75,000, higher of this two comes to 3,75,000. I hope this is quite clear to you all. So we have calculated GAV. So now we will start calculating our municipal taxes. Okay, the municipal taxes detail are given in the question. So the detail given in the question is municipal taxes for house 1 is 12% in case of house property 1, 8% in case of house property 2, and 6% in case of house property 3. So let's come back to our format book. On 3 lakh we will calculate 12%, which is equal to 36,000. 36,000 will be subtracted from 3,50,000, okay, minus plus 3,50,000 is equal to our net annual value is equal to 3,14,000. On 3,60,000, that is the municipal value for house property 2, we will calculate 8%, which will be equal to our municipal tax, that is 28,800, okay, and finally our NAV will be equal to minus plus 3,60,000, which is equal to 3,31,200. In case of house property 3, the municipal value is 3,30,000. On this we need to calculate 6%, so which is equal to 19,800. So our annual value for house property 3 is equal to minus plus 3,75,000, okay, so which is equal to 3,55,200. I hope this is quite clear. After you have calculated till here, do not move further and calculate this part over here, okay, it will become difficult, okay, to find out which property will be self-occupied property and which property will be deemed let out property. Okay, so what is our question is asking? Our question is asking, compute Ganesh income from house property for the assessment year 2020-21 and suggest which house property should be adopted by Ganesh to assess as self-occupied house property so that his tax liability is minimum. So we will utilize this second table in our format book. So in this I have written over here case 1, case 2, case 3. So what is this case 1, case 2, case 3? In case 1, I am assuming I will keep house property 1 and 2 as SOP and house property 3 as DLOP, that is deemed let out house property. In case 3, I am thinking house property 1 and 3 will become self-occupied house property and house property 2 will become a deemed let out house property. And in case 3, house property 2 and 3 will become SOP and house property 1 will become DLOP. I hope this is quite clear. And what details I have feed in the particulars? I have feed the details of income from house property. That means the NAV details we need to write over here for house property 1, house property 2 and house property 3, and then we will reduce standard deduction and interest on the loan and we'll find out income from house property 1. I hope this is quite clear by now. So we'll simply feed details, okay, we need to fill these details over here. I hope this is quite clear. So I hope you all have understood this part. So what details we need to feed over here, that we have to understand, because that is the task. It is not at all complicated, okay, just stay calm. So in case 1, what I have assumed, that house property 1 and 2 is self-occupied house property. That means the NAV details for this house property 1, if they are self-occupied house property, will be 0. I hope this is quite clear to you all. That is what we have studied in our notes, okay, in the format, that if a self-occupied property is there, that means his NAV will be 0 over here. If you can see, the NAV is 0, okay. So in our format book, even if we have calculated this NAV as 3,14,000, since in our case 1, the house property 1 is the SOP and house property 2 is the SOP, we will feed the details over here as 0, okay. I hope this is quite clear. But in place of house property 3, we will write 3,55,200. I hope this is quite clear to you all, okay. But in case 2, house property 1 and 3 are self-occupied. That means 1 and 3 will be 0. And in case of case 3, house property 2 and 3 are self-occupied house property. That means income from house property 2 and 3 will be 0 in case 3. I hope this is quite clear. So the income from house property 2, we need to write the details of the NAV in here. I hope this is quite clear. So we will write that 3,31,200. So we are assuming that this house property 2 will become our deemed let out property, and here our house property number 3 will become deemed let out house property in case 1. Okay, in case 3, our house property number 1 will become the deemed let out house property. So the NAV is equal to 3,14,000. I hope this is quite clear to you all. Okay, so the standard deduction will not be available over here. Okay, will not be available here, and similarly will not be available here, and similarly here also, because standard deduction is available on the NAV. So where the NAV is 0, below that the standard deduction will be 0. I hope this is quite clear to you all. I'll just make a line over here so that it do not create a confusion in your head. Okay, I hope this is quite clear to you all by now. Okay, so we need to calculate 30% of the standard deduction on this in case 3. That means the house property 1 is a DLOP, so we will calculate that. Okay, so the standard deduction at the rate 30% on 3,14,000 will be equal to 3,14,000 into 30% will be equal to 94,200. Okay, so similarly for in case 2, where house property 2 has been assumed that it will become a DLOP. Okay, so we will calculate the standard deduction on that also. 3,31,200 into 30% is equal to 99,360. And in case 1, where the house property 3 has been assumed to be DLOP, we need to calculate the standard deduction on 3,55,200 into 30%, which is equal to 1,06,560. Okay, I hope this is quite clear to you all. Okay, even if the property is a self-occupied property, that means in case 1 and 2 are self-occupied property, interest on loan will be allowed as deduction. I hope you all very much versed with that. Okay, and similarly in case of deemed let out property also, interest on loan will be allowed as deduction. I hope this is quite clear. So now let's move back to our question and see that what details are given. In case of house property 1, no loan is been taken. Okay, so there are no interest payments. Okay, so we will simply feed the detail of that in our solution. Okay, so we will put a 0 over here since interest on loan is not there in case of a house property 1. How to utilize this format? House property 1, in case this house property 1 is a SOP and DLOP. Okay, so if a house property is a DLOP, then this deduction will be available and the NAV will be considered. But if a house property 1 is SOP in case 1 and case 2, the NAV will be 0 only. I hope this is quite clear. So the income from the house property in case 1 will be 0, in case 2 will be 0, but in case 3 where the house property is a DLOP, the income will be 3,14,000 minus 94,200, which is equal to 2,19,800. So basically this is the income. Okay, and the rest of the house properties detail we need to see. Okay, so don't worry, let me complete this entire table. It is like Sudoku. Once you solve this, automatically things will be right, because the solution given in the study material is little critical. Okay, and it is time consuming. If you are understanding this format, understand it properly. Okay, otherwise things will become little difficult for you all. Okay, so let's feed the detail for the next part, that is if the house property number 2 is considered as self-occupied house property or deemed let out house property or self-occupied house property. Okay, SOP, DLOP, SOP, that is what here in case 2 we have written. 1 and 3 are SOP and house property number 2 is DLOP. That is what we have done over here. Okay, let's feed the detail from the question regarding the interest on loan. Okay, so the question says that in case of house property 2, okay, interest on money borrowed for repairs of property during the current year was 55,000. But if this house property 2, if it becomes SOP, then the maximum limit given to us in our notes, what we have studied was, if the house property is a self-occupied house property and interest on such loan for the self-occupied house property is paid for repairs and renovation, then the maximum interest allowed is 30,000 per annum. Okay, so we need to see that as well. Okay, so if the house property 2 in our example will be a SOP, then we have to consider 30,000. But if this house property 2 is DLOP, then entire 55,000 will be allowed as deduction. I hope that is clear by now. Okay, in case 1, house property 2 is SOP, so that means only up to 30,000 deduction will be available. I hope this is quite clear. So income from house property 2 in case 1 is minus 30,000. I hope this is quite clear. But in case 2, the house property number 2 is a DLOP. You can see over here, I am marking it over here. So that means entire 55,000 will be allowed as deduction. I hope this is quite clear to you by now. So we need to find out in case 2 the income from house property. So let's find that 3,31,200 minus 99,360 minus 55,000, which is equal to 1,76,840. I hope this is quite clear. But in case 3 again, the house property 2, in case 3 the house property 2 is again self-occupied house property, so here only up to 30,000 deduction will be available. I hope this is quite clear. So the income from house property 2 in case of case 3 will be minus 30,000. I hope this is quite clear. So for case 1 and case 3, the income from house property 2 is 30,000, that is loss of 30,000. I hope this is quite clear. In case the house property 3, so in case 1 the house property 3 is a DLOP. Okay, so the interest, we have to see how much interest has been paid. Okay, so in case of house property 3, the interest is paid of 1,75,000. I hope this is quite clear to you all. 1,75,000. So let me come here. So entire 1,75,000 will be allowed because this interest was taken for the purchase of the property. Even this house property is a self-occupied house property, then 1,75,000 total will be allowed as deduction. Okay, because the maximum limit is 2 lakhs only. I hope this is quite clear to you all. So we will feed the details. Since the house property number 3 in case number 1 is a DLOP, so that means entire 1,75,000 will be allowed. I hope this is quite clear to you all by now. Okay, so the income from house property 3, let me see how much it comes to. 3,55,200 minus 1,06,560 minus 1,75,000, which comes to around 73,640. So this is income. So this is a positive income. But in case of house property number 3, where case 2 and case 3 says that house property number 3 is SOP. So 1,75,000 will be allowed. I hope this is quite clear to you all. 1,75,000 will be allowed, and here also 1,75,000 will be allowed. But if you can see that in this particular case 3, 1,75,000 is allowed, okay, but there are two self-occupied house property, okay. In case number 3, 2 and 3 are self-occupied house property, and the maximum amount of deduction aggregate that can be allowed is 2 lakhs, okay. So that means I have to concise it, okay. House property number 3 here is a self-occupied house property in case number 3, as well as house property 2 is also a self-occupied house property. So this 30,000 deduction is available for renovations, okay, and 1,75,000 over here is allowed for construction and purchase, okay. So the total of this 30,000 and 1,75,000 plus 30 comes to around 2,05,000, but the maximum limit is of 2 lakhs only. That is what we have studied in our notes over here, okay. Aggregate of 2 lakh will be allowed for purchase as well as renovation, okay, if the house property is a SOP. I hope this is quite clear. So that's why this format is little bit critical. Once you understand this format, that time things will become easy. So that means maximum up to 1,70,000 only. I'll change the color of this. So the maximum deduction can be available under section 24 subsection B in case of a house property 3, which is a self-occupied house property, is 1,70,000. I hope this is quite clear to you. So finally we need to club the incomes, okay. So let's do that, okay. So the income of the house property 3 in case 2 is 1,75,000, that is negative. In case of this house property 3 in case 3 is minus 1,70,000, okay. So let's club, okay. What we need to club? This and this. Let's club it now, okay. 73,640 minus 30,000, okay, which is equal to positive 43,640. In case number 2, where house property 1 and 3 are SOP and house property 2 is DLOP, the incomes are 0, 1,76,840 and minus 1,75,000. So let's calculate that. 1,76,840 is the income minus, which is a loss of house property 3 in case number 2, which comes to around 1,840, okay. In case number 3, okay, we will add this and this, okay. So 2,19,800 minus 30,000 minus 1,70,000 is equal to 19,800. So basically the case 2 is the best case, because in case 2 the least income will be taxable, okay. So basically we will consider the case 2 as the appropriate case for Mr. Ganesh. I hope this is quite clear. So I have solved this question in this format, okay, but it might be little tricky for you all. So let me make it little simple for you all, okay. So let's assume in this manner, this question was given to us and the question has only told us that house property 1 and 3 are self-occupied house property and house property 2 is the DLOP. So we will write that over here, okay. SOP and this is DLOP, okay. House property 1 and 3 are SOP and house property 2 is the DLOP. So if this is the detail given to us, now you solve this solution on your own and you will find the answer of this case 2 only, okay. I hope this is quite clear. So that's why we have to evaluate the combination, that is the permutation and the combination, which house properties should be SOPs and which house properties should be DLOP. So that is what these cases are the combinations of, okay. And we need to be aware that if these two house properties are SOP, then the interest of the loan cannot exceed 2 lakh. So that's what was happening in this case 3. In case 3, the house property number 2 and house property 3 are the SOP, okay, and in the question they have said that 55,000 interest has been paid for house properties 2 renovation. So in house property 3, the detail is given that interest of 1,75,000 is paid for the purchase of the house property. That means this total, okay, this total will be clubbed, which is equal to 55,000 plus 1,75,000 is equal to 2,30,000, but the maximum aggregate limit if these two house properties are SOPs, okay, then the aggregate limit will be 2 lakh. So that is what we have done in this format, okay, where house property 2 and 3 were both SOP, okay, but in case 1 what happened was 1 and 2 was SOP, okay. So in our question these 2 were the SOP, so the 55,000, this whatever interest has been paid by the assessee for house property number 2, there is a any which ways maximum limit of 30,000. So that is what we have considered over here. I hope this is quite clear to you all. And in case number 1, the house property 3 was the DLOP. That's why the entire interest will be irrespectively will be allowed. We don't need to see whether it will be allowed or not. I hope this is quite clear. This was quite a tricky sum, okay. Try to solve the sum considering this what I have written over here, SOP, DLOP, SOP, okay. After solving that, again rewind my lecture and listen this part, okay, of this sum, okay, what we have solved for illustration number 8, okay. Listen it one more time, then you will be very comfortable with this format, okay. Once you are comfortable with this format, automatically you will find this format given in the solution in our study material little outdated, okay. So I hope it is clear to you all by now, okay. So let's solve one more question. The question is on page number 4.145, okay, and the question number is illustration 9. Prem owns a house property in Madras during the previous year 2019-20, okay. 2/3 portion of the house property was self-occupied and 1/3 portion was let out for the residential purpose at the rent of 8,000 per month. Municipal value for the house property is 3 lakh per annum. Fair rent is 2,70,000 per annum and rent, that is the standard rent, is 3,30,000 per annum. He paid municipal taxes at the rate 10% of the municipal value during the year. A loan of rupees 25 lakh was taken by him during the year 2015 for the acquisition of the property, okay. Interest on the loan paid during the previous year 1920 was 1,20,000, okay. The interest details are given. Compute the Prem's income for the house property for the assessment year 2020-21. So we will basically solve our solution in this format only, okay. So let's read the question again, okay. The question says that Prem is a owner of a house property in Madras during the previous year 1920. 2/3 of the portion of the house property was self-occupied and 1/3 portion was let out for the residential purpose at the rent of 8,000 per month, okay. And the municipal value details and the fair rent detail and the standard rent detail is given, and the municipal taxes detail are given, as well as the loans detail is given, and the question has itself specified how much the assessee has paid the interest. I hope this is quite clear to you all. And the question is asking to calculate the Prem's income for the house property for assessment year 2020-21. So how it will be calculated? We will write firstly the details, that is the name of the assessee is Mr. Prem, okay. Residential status assumed resident, ordinary resident. So we will write here self-occupied property and let out property. So 2/3 of the house property is self-occupied and 1/3 of the house property is let out. I hope this is quite clear. So the municipal value, fair rent, whichever is higher, as well as the standard rent and the expected rent and the actual rent and the gross NAV and the municipal taxes and the annual rent will be 0 in case of the house property which is self-occupied house property. I hope this is quite clear to you all, okay. So we need to calculate the details for the let out property, that means the GAV for the let out property. So what the question is saying, 1/3 portion of the property was let out for the residential purpose at the rent of 8,000 per month. That means 8,000 into 12. I hope this is quite clear, which is equal to 8 into 12, which is equal to 96,000, okay, which is equal to 96,000. So we will write in place of actual rent 96,000. We'll feed that detail as the question is giving us, okay. And then we will read the next detail. The next detail is municipal value of the property is 3 lakh per annum. So basically the municipal value is for the entire property, that means one property, but this one property is divided into two parts, that is 2/3 and 1/3. Since the property is divided in this parts, then the property portion, then the properties portion which is let out will be calculated. That means this 3 lakh will be calculated in the portion of the let out, that is 1/3. That means 1 lakh is the municipal value. I hope you all have got the hint how to solve the sum now. That means our municipal value will be 1 lakh. I hope this is quite clear. Then the next detail is given about the fair rent. The fair rent is 2,70,000 per annum for the entire house property. So 2,70,000 will be divided into the portion of the house property that has been let out, that is 1/3, which will be equal to 90,000. I hope this is quite clear. So in our format, in place of fair rent, we will write 90,000. I hope this is quite clear to you all. But the standard rent is given is 3,30,000. So this 3,30,000 will be divided in the portion of the let out property, that is 1/3. So that means 1,10,000 is the value of the standard rent. I hope that is quite clear. So we will feed that detail 1,10,000. Wait, at the wrong place I feed that detail. 1,10,000. So let's calculate the GAV now. We'll compare this to whichever is higher of this two will become our, whichever is higher, that is 1 lakh. Okay, whichever is lower of this two will become our expected rent. Okay, the expected rent is equal to 1 lakh. Okay, whichever is higher of this two will become our GAV, which is equal to 1 lakh. I hope this is quite clear by now. Okay, so the municipal taxes details are given in the question. Okay, the municipal taxes are paid 10% of the municipal value. So we'll calculate as per our format only 10% of this. Okay, so 10% of our municipal value, that is the let out portion, is equal to 10,000. I hope this is quite clear. So finally our NAV is equal to 90,000. I hope this is quite clear to you all. Okay, so now we have found out our NAV. So we need to find out the deduction under section 24. Deduction under section 24 will be available for LOP and not for SOP. So we'll put a dash over here. So deduction under section 24 subsection A is 30% of the NAV. That means 90,000 into 30% is equal to 27,000 is allowed as deduction. Okay, so the next deduction available is under section 24 subsection B. Okay, so we need to see whether the details of the loan are given in the question or not. Okay, so the details of the loans are given in the question. So this 1,20,000 will be again divided into two portions, that is 2/3 and 1/3. 2/3 is for SOP, okay, and 1/3 is for LOP. So let's divide it. Okay, so let's calculate the interest paid for the SOP. Okay, so which is equal to 1,20,000 into 2/3, which is equal to 80,000. Okay, and the interest paid for the LOP is equal to 1,20,000 into 1/3, which is equal to 40,000. I hope this is quite clear to you all. So basically these details we need to feed in our format. Okay, so come into our format. Interest on loan, okay, this will be available to an SOP. Okay, so for SOP 80,000 was paid. Okay, and for LOP 40,000 was paid. We have bifurcated that 1,20,000. I hope this is quite clear. So basically loss of 80,000 is from the self-occupied portion, and income from house property from the let out portion is 90,000 minus 27,000 minus 40,000, okay, which is equal to 23,000. I hope this is quite clear to you all. Okay, so basically this is an income. So if there is no other income given in the question, then this 80,000 loss can be set off against this 23,000. I hope this is quite clear to you all by now. Okay, basically in the notes on page number 2 we have studied this point too. That's why I have explained this question to you all. Okay, I hope this is quite clear to you all. So finally the net income of the assessee, okay, from the let out portion will be 0. Okay, because the 80,000 loss will be set off against this 23,000, and whatever the loss is remaining will be carried forward for the next previous years. I hope this is quite clear to you all. Okay, so the difference of this two will be equal to 80,000 minus plus 23,000. Okay, so basically 57,000's loss will be carried forward. I hope this is quite clear to you. So let's see the solution given in our study material. Okay, so they have given the same solution only. Okay, so as you can see, the annual value is calculated 90,000, on that deduction is calculated, and finally the let out portions income is 23,000, but the loss from the house property which was self-occupied was 80,000 plus 23,000, that means 57,000 loss will be carry forward. I hope this is quite clear, and here our chapter income from house property comes to an end completely. I hope this is quite clear to you all.